Got rate-sensitive sectors like real estate, like utilities, like financials, softer on the day. Hawkish monetary policy, depressing market sentiment pretty much across the board. European equities right now logging their longest daily losing streak of the year. That's led by declines in banks, automakers, and tech. Sovereign debt yields edging back up. Short-term treasuries right now at their cheapest levels going back to early March. And big gaps today in currency markets. Big declines again for gold and a big reversal for crude oil, which yesterday actually looked poised to actually break above some of those short-term moving averages, at least today, right now, erasing all of the gains that it had made on Wednesday. Negative sentiment across all asset classes, negative sentiment across all sectors, and that is where we start with expectations for the unexpected. The Bank of England catching a lot of folks off guard, a surprise with a 0.5 percentage point rate cut. Central banks in Norway, Switzerland, even Turkey also tightening policy as those price pressures persist.
Well, I understand the difficulty and the pain it causes for many people, and I do understand that. What I would say, though, is that if we don't get inflation back down to target, then it goes on for much longer, and the pain goes on for longer, and none of us want that.
The global central bank warnings this week, punctuated by 2 days of congressional testimony from one Jay Powell, the U.S. Fed chair, before a Senate committee today, repeating the message he shared with the House yesterday, a message that the Fed remains laser focused on reducing inflation back to target levels, despite lawmakers' concern about the knock-on effects of tighter credit and higher unemployment. And it is against that backdrop, Katie Greifeld, the J.P. Morgan strategist Marko Kolanovic, says that the lagged effects of all of this rate tightening maybe hasn't quite caught up with this yet, and says that the second half could actually be a little bit of a roller coaster for equities.
Could be tumultuous, I believe. That's how Marko Kolanovic phrased it in his mid-year outlook. Tumultuous if we don't see those Fed cuts that have been priced into the market materialize. And let's look at how the market is valued right now. You're looking at the S&P 500's cyclically adjusted PE ratio relative to the emerging markets MSCI index. As you can see, really, it's been a steady march up and to the right going back a decade or so. So this is still a very expensive stock market. And let's look at what's actually priced in when it comes to those rate cuts. Just 6 basis points priced in this year when it comes to cuts. Of course, we've heard from Powell himself over and over again that really the focus is still on fighting inflation. That talk about rate cuts is probably premature, and as a result, you've really seen that pricing come out of the market. So going off what we heard from J.P. Morgan, looking at what's priced in right now, it could be a bumpy second half for the stock market, Romaine.
All right, well, Jay Powell has ended that semi-annual pilgrimage up to Congress, 2 days of testimony, and this time he was before the Senate Banking Committee, reiterating what we heard yesterday, quite frankly, reiterating what we heard about a week ago after the FOMC decision. Stephen Stanley, Chief U.S. Economist over at Santander, joining us right now live in the studio. Let's talk a little bit about what we heard, not only out of Jay Powell, but how it links with what we learned out of the dot plots and the other projections about a week ago. He's making it clear that they plan to stay this course.
Yeah, I mean, the dot plots last week were quite surprising. They showed a Fed that's still pretty hawkish. They're looking for 2 rate hikes between now and the end of the year. I think the markets were expecting somewhere between 0 and 1. Mm-hmm. So we kind of reset expectations a little bit, and he certainly reinforced those sentiments today.
There's still been a lot of discussion about economic conditions and whether that's going to really overlap in a way with what the Fed has been projecting with regards to rates. When you look at weekly unemployment claims, up for a 3rd straight week here, and I know that data can tend to be a little bit volatile, but there have been a few other data points, too, that have suggested there is some economic softness out there.
Look, the economy is kind of in a mixed spot right now. There are certain sectors that are doing well and others that aren't. It feels like the consensus view for at least a year, maybe longer, has been that the economy was just a few months away from recession, and that's kind of the prevailing idea now as well, and the economy just seems to continue to plug ahead. So for all the, I mean, we could talk about all the different indicators. For all the weak ones, I could come up with a strong one to counteract. It feels like the economy's slogging along, but what has been very resilient are the 2 things the Fed cares the most about, the labor market and inflation.
We'll talk about the relationship between inflation and the labor market because, okay, we're back down to 4% on headline CPI. At the same time, you still have the labor market very resilient. You still see wages coming in at a pretty robust level. When you think about the path to 2%, is it necessary that we crack the labor market?
I think that's an important piece of the puzzle. I don't think it's the only one. There's been a lot of debate lately. I think the way that Chairman Powell set up the inflation picture, and this goes back about a year now, where he divided core inflation into the three pieces, and the third being the core services ex housing, and that's the one he says the Fed is focused on. And then he immediately linked that to the labor market, which does make some sense, right? Because most service companies, their number one input is labor, so that's their biggest cost as they look at their price structure. But, you know, I think in some ways, wages and prices, they're correlated, but it's not clear to me that wages cause prices exclusively. I mean, I think it goes both ways, right? If you're a worker and you're saying high inflation, you go into the boss's office, you say, hey, I need a raise, right? So inflation can cause wage growth as well, and how those two interplay, I think, is pretty complex relationship.
I also want to get your thoughts on what the tightening impulse coming out of the events that we saw in March related to the financial sector have actually been. Because the thought experiment at the time was, how much is the less availability of credit going to mean in terms of tightening? I feel like Wall Street landed on 25 to 50 basis points of tightening. But you look at financial conditions, you sort of listen to the commentary from Jerome Powell and other members of the FOMC, and it seems like that isn't necessarily the case anymore. What's your current thinking on that?
Yeah, I think that there was a lot of fear when SVB went down in March that you were going to see kind of a cascading effect that was going to affect all the regional banks, and there was potentially going to be crisis in the financial sector. And that obviously has a whole set of implications that would be pretty dire. And the markets immediately priced some probability of that scenario in. But the second piece of it is simply that banks are going to have to be more careful. They can't view their deposits as quite as stable as before. Rates are rising. So generally, credit conditions are going to have to tighten up a little bit. And I think what we've come to, now that the crisis piece seems to be off the table for the time being, is that the degree of tightening that we're seeing in lending standards is pretty much what you would expect to see in any tightening cycle. I mean, when the Fed is raising interest rates, credit conditions always tighten. And that's kind of the rhetoric that you're hearing out of the Fed lately as well. What we're seeing is just pretty much consistent with our tightening and not that much more than that. And so the Fed is seeing this not so much as a risk factor still, but what we're seeing right now is not so much an independent piece, but it's just another symptom of generally what they're trying to do in terms of credit conditions.
Stanley, we just have time for one more question, and I kind of want to go a little bit global here, because when we look at what the BOE did today, Bank of Norway, and obviously a much smaller central bank there, but even some of the other central bankers out there who seem to be pounding the drum, even more so than the Fed, the idea that they have sort of inflationary pressures, price pressures that have not abated and maybe aren't as transitory or cyclical as maybe they are here in the U.S. Does that at all feed into what happens here in the U.S. economy?
Well, I think it's a consistent theme across a lot of the major economies of the world. You know, the UK, there was some thought that maybe they were the Bank of England was done. Similar story in Canada and Australia, and those central banks have had to come back to the table. And I think you're seeing that with the Fed too. I mean, there was a lot of consideration that maybe the Fed was done, and now, of course, Chairman Powell and others are talking about potentially 2 more rate hikes. So I think that is all a function of the fact that inflation has proven pretty stubborn. Headline inflation has come down, but core inflation remains quite high and isn't showing a lot of downward momentum right now.
All right, Stephen, great to catch up with you. Stephen Stanley there, Chief U.S. Economist over at Santander. We do want to get you some breaking news going on over in Africa, specifically with Zambia, a debt deal, $6.3 billion. We don't necessarily know all of the details, but this has been a big topic of discussion over in Paris right now, where that summit for the new global financing is taking place. We are learning that Zambia, which of course had been indebted to some of the Paris Club members as well as China, has now reached an agreement in principle to restructure about $6.3 billion of debt with bilateral lenders. And of course, the big deal here is that this is the first of the biggest, and more importantly, the first debt renegotiation under the common framework that we've had. And now there's a lot of talk about some of the other nations that have to do the same, Kitty.
Yeah, of course, this is seen as sort of a test case for those other nations, those developing nations. Interesting to see see this news out of Zambia, of course, a 3-year grace period as it begins repaying those loans over that 20-year schedule.
We're going to try to get you some more details on this. Meanwhile, we have a lot more coming up here on the show. Narendra Modi, the Prime Minister of India, is right now at the White House in Washington, D.C., scheduled to address Congress a little bit later. A flurry of deals involving military, tech, and other corporate CEOs lining up right now to be a part of the Indian economy. We're going to let you know what he has to say, what he's trying to sell to the rest of the world. Plus a look at global infrastructure. Dylan Fu, head of global infrastructure at Apollo, going to be stopping by the big program in just a second. And strategists over at Barclays making headlines today with a call on AI stocks. They say the run-up, it ain't over. We're going to take a closer look as to why they think investors should maybe chase this rally. That's coming up in just a bit. This is Bloomberg.
Thing in life I've often said is to be happy, but you seem like a very happy person.
It's like nature. Nothing ever stops. So you could be super happy in 1 minute and then something happens. So it's just living. It's the joy of life.
For any young woman that's watching this, wants to be the next Diane von Furstenberg, what would you recommend?
I think the most important thing in life is the relationship you have with yourself. Once you have a good relationship with yourself, any other relationship is a plus and not a must. And the second advice is to be as true to yourself as you possibly can. And you have to accept and own things you may not like. But the more you could be you, the happier you will be.
News breaks. No one covers the world like Bloomberg.
On the AI question, what we don't really see is Apple doing a knee-jerk response and moving into the domain of generative AI.
Supporters of President Recep Tayyip Erdogan celebrating late into the night, dancing and singing.
We have a fundamental reassessment of everybody's capacity within OPEC. Should we talk about $95 and $100 oil again? Not for a while.
Bloomberg, your global business authority.
Well, to say the least, the AI boom has captured the attention of Wall Street this year after NVIDIA's blowout guidance. Barclays strategists are saying they're all in and that investors should buy the dip even when the AI stock rally fizzles out. For more, let's bring in Abigail Doolittle.
Boom? What boom, Katie? Take a look at these gains on this year. It's pretty amazing given the fact that we're not even officially halfway through yet. NVIDIA up 195%. Tesla has doubled. C3 AI up 231%. And AMD up a measly 74%. Just huge, huge gains. So there is this worry from most folks that there could be some kind of bubble brewing here. But let's take a look at NVIDIA over the last 5 days, or actually let's take a look at the stocks over the last 5 days, because NVIDIA, interestingly enough, over the last 5 days is up slightly. But you can see we do have a bit of a pullback at this point, down 4.8%, the worst stretch since late April. So that is does represent some investors and traders taking some profits off the table, maybe concerns that this is something like the tech bubble. As for valuations and Barclays' call, it's a pretty brave call for them to be saying that you want to be buying AI-related stocks tactically. Right now for NVIDIA, it is working because, again, over the last 3 days, it's higher. But if we go into the Bloomberg terminal and take a look at valuation, I would call this not so extreme. What we're looking at here is the forward PE on NVIDIA, and you can see overall around 25 times, rich relative to the S&P 500, which is typically closer to 17, 18 times. Take a look at where it is now, right above 50. Now, yes, it's not at the peak, the two peaks above 60, but nonetheless, we are so far, Romaine, above that 20-day or that 20-year average, and along with some of the more trough levels. This valuation right now, priced to perfection, assuming nothing is going to go wrong with AI.
Yeah, that's an interesting bet there. Leo Kelly joining us right now, Verdant's Capital Advisors CEO. He's seen it all along an illustrious career that I think started from somewhere good. Now you're in a much better place, Leo. When you look at this rally in AI stocks, do you think that there's something there to actually go after?
Well, it's interesting, Romaine, when I was at Bloomberg starting my career, the tech stocks were taking off in the 90s, and we were starting to reach some really spectacular heights. And I heard a lot then what I'm hearing now, that it's different when the businesses have earnings, that the industry is going to be a constant growth machine, and that ignore valuation. What we also saw was price targets just getting raised for the sake of them crossing the old price target. So valuation matters. People discovered that in 2000, and it wasn't just the pets.com, it was Cisco, it was Microsoft, all corrected. So I think you have to focus on valuation.
Well, I want to go there, too. I'm glad you brought that up here. I should point out, too, actually, at one point in my career, I actually interviewed the pets.com SOC, by the way, which was the highlight. But a lot of people, and I'm just going to play devil's advocate here for a second, Leo. Sure. Some would say, okay, this time around, what's being bought are NVIDIA's and Microsoft's and companies that have well-established track records of revenue growth, profitability, et cetera, et cetera. Unlike maybe, I guess let's just face it, there was a lot of garbage floating around back in the late 90s, early 2000s.
Well, there was a lot of garbage, but there was a lot of great stocks. Microsoft was great, and when it collapsed starting in 2000, it didn't make a new high for a couple decades. Cisco was a wonderful stock that went from 90 to 9. And I'd point out, everything they said about the internet came true. Every wonderful story that came about came true. Now, by the way, Romaine, what we also had was Netscape. And Netscape turned out not to be the clear winner that everyone thought it was. It turned out to be Google. So don't get me wrong. NVIDIA, great company. Apple, great company. Microsoft, great company. But those three stocks are 30% of the S&P 500's gain this year. They are running, and they are running quickly. The problem with the bubbles, and whether this is the beginning of or a more mature in, and I think we're in the middle, is that they can go anywhere, and it's impossible. So the Barclays call we talked about earlier, is it really brave? They're just taking the trend, and they're calling it higher, and the trend will continue to go higher until it doesn't. And you never really know what turns that over. We like to tell our clients, stay diversified, focus on valuation.
Well, when you think about valuations, I mean, even if you're not in the business of trying to pick which will be the winners of this AI boom, who will be the Google, the Amazon of this AI boom, you can't ignore it at the index level when it's inflating the valuation of the index. And with that in mind, I mean, are you staying away from the S&P 500, the NASDAQ 100? Where are you actually looking for that diversity?
Yeah, that's such a great question right now specifically. We are in the camp that the S&P 500 and NASDAQ are being blown up through just a few names. There is some value in this market. It's at the bottom level of the market. It's in value. It's in small cap. It's in international. But it's also in cash. You know, it's an interesting moment in time we have here. We finally have a rate of return on cash. So holding a little bit of cash on the sidelines, now it pays us. But more importantly, we believe the opportunity value of that cash is going to be very valuable. I heard earlier us talking about the Fed and interest rates. The Fed is going to be aggressive because just because we've seen 4% inflation does not mean we're out of this thing. More inflation is coming. We have not significantly impacted M2, the supply of money, enough to combat inflation. So we're in the camp that the economy has maybe a little bit more turmoil in the second half of the year and early in the following, and then we come out of it and we'll be fine. So I would definitely say cash is your friend, value, small, international, all good places to be.
And Leo, we don't have much time left here, but on cash, you've heard some warnings just in the past couple of weeks that there is a cash trap to avoid. When does cash continue, or when does it stop working? Does that really depend on when we get the first rate cut?
And again, I don't know that we're getting a rate cut for a while. I think the market's missing that M2 went up 40% over 2 years, and it's only pulled back 4. I think we have a while for that. I think cash is safe for the foreseeable future, and we're going to get a rate of return. Now, it may bounce around a half a point or so back and forth, but I don't think we're running back down to 1. But again, I would remind the viewers, there's 2 returns to cash: the yield and then the opportunity value. If you're holding cash and this market gets hit, we go into recession and you see a pullback of 10, 15, 20%, having that cash becomes immeasurably valuable, far more than the actual yield that the cash is paying at the moment.
All right, Leo, great stuff as always. Leo Kelly there. He's the CEO over at Vernon's Capital Advisors. Continuing our program here, a focus on the markets and a focus on the globe. All eyes right now on India Prime Minister Narendra Modi here in the United States, making the rounds through New York and today in Washington, alongside the President of the United States, ahead of a big address before Congress later in the day and a big state dinner later at the White House tonight. The 2 men there on your screen brokering a series of deals to improve military and economic ties. A conversation about the future of India and its relationship with the U.S. That's coming up after the break. This is Bloomberg.
Back in 1997, I was interested in the following question, which is, there are a bunch of the dinosaurs called sauropod dinosaurs, which had really long, skinny necks. So Apatosaurus is an example. Those had really long, skinny tails. So I made a computer model that showed that, in fact, the tail of these sauropod dinosaurs could actually act like a whip. A bullwhip. Now, the way a bullwhip makes that cracking noise is because the tip of the whip actually goes about twice the speed of sound. Okay. I think the way they got a date was to impress the females by making loud booms.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
With this visit, Indian firms are announcing more than $2 billion in new investments in manufacturing, solar in Colorado, steel in Ohio, and optic fiber in South Carolina, and much more. Further proof that America's manufacturing is back.
The President of the United States speaking just moments ago, a joint press conference with the Prime Minister of India, Narendra Modi, in town for his first official state visit. And Kaylee Lyons, who's down in Washington. There is a lot of buzz around this visit, not just with the members of Congress in the White House, but a lot of corporate CEOs lining up to shake this guy's hand.
Between these two countries. And of course, it's not just in technology, it's in defense. In theory, that is what Elon Musk is seeking here. Of course, he met earlier this week with Narendra Modi himself, and that is something else that Modi referenced in his commentary. So it just kind of goes to show you the attempts to invest economically in India, as well as from this defense militaristic standpoint as they look to counter China in the Pacific. One thing I would say, though, is that all of these efforts are underway despite concerns about human rights and democracy in India. And Modi did receive questions on that in the news conference. He then kind of danced around them, but he did did say that he is committed to democratic values.
Yeah, certainly. That kind of ends up being the elephant in the room. Kayleigh, I'm wondering if you could set the scene for us. We do know that he is expected to preside over a joint session of Congress, a speech there. How do you think he's going to be received by the rank and file?
Well, it's a complicated question, Romaine, because he will be meeting with Speaker Kevin McCarthy, House Speaker, before he addresses the joint session. But there are going to be lawmakers who are sitting that out. The likes of Alexandria Ocasio-Cortez, for example, one of the progressive Democrats, and several others like her have decided not to attend because of some of these human rights issues I was just talking about. That's not to say that there won't be both sides of the aisle represented. I was on Capitol Hill earlier today speaking with both Republican and Democratic senators who talked about the strategic importance of India as a partner in this specific region in particular. The likes of Senator Bill Haggerty, who said that it's incredibly important in that region. And then a Democrat, Bob Menendez, talking about how India is a crucial part of meeting the China challenge. And both of them indicated that they are glad that Modi is here in Washington. So certainly there will be some that are more receptive to him being here than others who are focused on some of those other issues domestically in India.
Certainly it's time to shine right now. Of course, all the attention here in Washington and abroad, and of course back home, an economy and a stock market doing well. Kayleigh Lyons down in Washington. We'll check in again with her and the crew of Balance of Power a little bit later in the day. Meanwhile, we do get back to what's going on in U.S. equity markets. Another mixed bag here. We are fresh off the lows of the day here with the S&P in the green, up 0.2%. The
maybe I should go do something else. I can't do anything better than I'm already doing. I've already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable. I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special
This is Bloomberg Markets to close, almost 2:30 here in New York. Time to get a look at what's been going on in New York. Time to get a look at what's been going on in the commodity space. Standing by right now with our commodity close is Abigail Doolittle. Abigail.
Well, yesterday's leaders, Romaine, are today's laggards, except for natural gas. It just seems to be flipping higher now. New York crude, that down 4.2%. This, as Jerome Powell, Fed chair, of course, is a little bit hawkish to some reading. I would say that he's actually saying what he's been saying all along. But this does have the Bloomberg Dollar Index higher, which is pushing down commodities overall. Natural gas had been down before, I think, but I don't know. Now we see it flipping higher just a little bit. Palladium down 5%. And then interesting, corn yesterday up more than 5% on weather. One of the worst corn trading situations going all the way back to, I believe, the 1990s. Well, today, that rally, it's cooling off a little bit. And Romaine, it is down 1.3%. Overall, the Bloomberg Commodity Index down 1.5%. So the big volatility that we've been seeing in commodities recently, it's continuing.
All right, Abigail Doolittle there with a nice roundup of what's going on in the commodity space. There was an interesting conversation by the folks over at Odd Lots with Steve Eisman. You know him for his bets against U.S. mortgages right before the housing bubble burst back in 2008. But now he's finding value in infrastructure. In an interview that he had with Joe Weisenthal and Tracy Alloway on the Odd Lots podcast, Eisman said that the biggest story is going to be the grid, meaning the electric grid. He said it's absolutely crucial, and he estimates that improvements, at least here in the U.S., are like $200 to $300 billion. What he says are unbelievable numbers, and that's not just a story here in the U.S., it is a global story. Dylan Fu is at the forefront of that. He is head of global infrastructure over at Apollo, and he joins us right now to talk about the build-out, the chasing of some of those infrastructure investments, Dylan. And I'm curious if you can kind of start off with what you're seeing outside of the U.S., particularly over there in Europe.
Thanks, Ryan. Thanks for having me. Look, I completely agree with Steve. I think the infrastructure story right now is really strong. It's a huge asset class. It supports global economic growth. It supports societal needs, both of which continue to be big factors in driving continued growth in new investments. But don't forget, a lot of infrastructure, like the grid we were just talking about, like a lot of transport assets, require ongoing CapEx and maintenance. So very capital intensive, and as a result of that, creates a lot of investments and a lot of opportunities for folks like us. And what we're seeing here in Europe is very similar to the US, actually. A big build out in particular of transportation infrastructure. It's crumbling to some extent. Communications infrastructure, which is a relatively new asset class within infrastructure, and also energy transition. And energy security, and all of those really have a lot of capital to be poured into it.
Another element that we've heard a lot of folks talk about, including from you and the folks over at Apollo, is sort of the digital infrastructure, data centers, and a lot of the other things that tie into that. Kind of explain how that fits in, Dylan.
Yeah, sure. Look, we just signed a data center deal in the last week, so it's very top of mind. But you think about this device that we use every day. Behind that sits a number of hard assets and infrastructure that make it work. And in particular, think about towers and cell towers that factor into the wireless capability to deliver the data. Think about fiber that's laid across the world and subsea. Think about data centers as well. Without those hard assets, this device and this conversation we're having now doesn't work. And the demand and need for data is increasing every day. You just talked about AI a couple of segments ago, and I was listening intently on that. AI will factor into this significantly. The ability to process that data, to store that data and consume it requires a lot of hard infrastructure that probably wasn't needed 30 years ago. So it's an exciting development for infrastructure investors, and we'll need a lot of capital to support the future needs of the society that we live in, which is increasingly digital.
Well, Dylan, put that into context for us, because when you ask people about AI, obviously you get people ranging from the opinion of this is just a natural evolution of, our increasingly digital lives to this is a total breakthrough. And when you think about the investment opportunities in digital infrastructure, where do you fall on those two camps?
Our job really in infrastructure, we're kind of the stable, hard asset behind it. It's not to predict who's going to win, who's going to lose. What I do know is the puck is going that way. And what I do know is that there will lead a lot more significant investments in particularly hyperscale data centers, which are custom built for guys like Microsoft, Google, in order to support the regional development and regional build out of that, to deliver content closer to the people that are consuming it. So I personally think AI will continue to grow at a steady pace. I'm not trying to pick who the winner is, but I do know that it's not just AI. It's business content, it's Zoom, it's social media, it's driverless cars, it's everything. The world we live in now is just a big consumer of data, and that's growing exponentially. Actually, if you look at the last kind of 5 years, and will continue to do so.
And Dylan, we started this conversation in Europe. Compare the different opportunity sets that you see in Europe versus the U.S. Where do you see the most opportunity right now?
Actually, rather than sector, we're seeing a lot of opportunity in the credit space. And you guys probably saw the news today, the Bank of England going up another 50 bips, I think for the 13th, 14th rate rise in a row. That's presenting a lot of credit opportunities for us here to finance these projects, particularly with banking markets closing down and tightening up in general and where spreads are. So that's really interesting for us. On the US side of things, I think energy transition is just going to be a huge part of what we're doing here. And that's really trying to build more and more power capabilities in a clean, sustainable way for the future of the world that we live in.
All right, Dylan, really great to get some time with you. Our thanks to Dylan Fu. He is Apollo's head of global infrastructure. Still ahead, there's some optimism for VUp Corp after naming its new CEO. more on who that is and how they might drive sales and boost performance for the apparel company. And as we head to break, a reminder that you can check out the Bloomberg Technology Summit on the terminal using the function Live Go. This is Bloomberg.
Upside. Young adults are facing some tough challenges. Higher living and education costs and wages that aren't keeping up with inflation are making it harder for them to support themselves. And they're relying more on the bank of mom and dad. A new Bankrate report shows nearly 70% of parents with kids 18 and older are putting their own finances in danger to help them. About half are dipping into their emergency savings or delaying paying off debt, while 43% drain their retirement funds. So where do you draw the line? There seems to be a generational gap, as older parents can't understand why being self-sufficient now is a lot harder than it was for them. Gen Z seems to think on average that 22 is a benchmark for covering the expenses, while baby boomers say their adult children should pay their own way closer to age 20. Either way, it's a family decision. Bankrate suggests having a conversation with your kids and setting a specific dollar amount or time frame for footing the bill.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people,
There's no question this industry is composed of some bad actors and some good actors.
the transactions,
Volumes have surpassed $24 billion per day.
and the technology.
Stop talking about the technology. Start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
All right, let's get a view from the sell side with our top calls, big movers on the back of analyst recommendations. And we start off with Tesla. The EV maker actually getting its second downgrade this week, this time from Adam Jonas over at Morgan Stanley, knocking his recommendation down to equal weight after a more than 100% run up in the stock year to date. Jonas has high expectations out there from AI. They've actually brought the stock to a fair valuation. Despite the downgrade today, the share is higher by about 1.5%. Next up, Kellogg upgraded to market perform over at Bernstein, with the analyst saying that the valuation there is cheap. This after the company announced it would split into three separate companies: Global Snacking, North American Cereals, and plant-based foods. Shares of Kellogg up about 0.8% on the day. And finally, Expedia. New travel coverage over at B. Riley that starts with a buy rating on Expedia. The analyst sees Expedia taking market share and adds that cost leverage and marketing efficiencies should also boost margin. Shares having a pretty decent day, up 2%, and those are some of our top calls. We do want to stick with the sell side here with the focus on VF Corp. Of course, they date all the way back to the 1800s. North Face, Vans, and a couple other really popular brands out there. They have a new CEO. Bracken Darrell will be taking over next month, and well, it's causing investors to maybe see brighter days ahead for the company as it seeks to sort of make itself a little bit more efficient, not only internally, but of course with customers and suppliers as well. BTIG analyst Janine Stichter says she's sticking with her neutral rating on the stock. Janine joins us right now to talk a little bit more about what's going on with VF Corp. And I am curious, Janine, when you look at the new CEO coming in, I know he doesn't start for a while here, are you a little bit more optimistic that maybe the direction, the management of this company will change for the better?
I think it's still too early to say exactly what his direction will be. Our view is that he will probably take the existing strategy that they have. They do have a turnaround plan in place, and put his own tweak on it, put his own spin on it, ultimately amplify that. But I think more importantly, what it means to have a new CEO in place is, for one, for the stock, it removes an overhang that we've had basically since last December when we had the management turnover of the question of who will lead this company into the next leg of growth. And then I think secondly, internally for the company from an organizational perspective, they've essentially been in a holding pattern, having some form of turnaround plan in place, but not really having a leader to realize that plan. So I think for the employees internally there, that's key in building the confidence that the plan is going to accelerate, that there is a plan in place, that there'll be someone to lead them into the acceleration of this plan.
Well, talk to us about what you think the plan should be. I mean, we talk about these iconic brands, but we know that fashion and apparel industry can be very fickle. People are into one brand today and then to another tomorrow. How does a company like this, that has such a long and varied legacy, how does it, I guess, stay fresh in the minds of consumers?
Yeah, I think that's the challenge that they have right now, particularly with the Vans brand, which is the biggest piece of their business. The Vans brand became extremely hot for a period of about 2 years pre-COVID, and then they kind of failed to innovate from there. And I think now they need to bring in new blood who maybe isn't as close to the industry but has an outsider perspective. In terms of what he does bring in terms of a relevant skill set, we do think he has a lot of expertise in consumer-facing industries. He spent about 10 years at Logitech, which is a consumer-facing technology brand, and ultimately did a lot there similar to what needs to be done at Vans in terms of product diversification and bringing a more relevant product assortment to the market. So he has experience there. I think also experience with brand turnarounds. That was a turnaround. He also turned around the Old Spice brand. And then lastly, I would say just being a public company CEO for a period of 10 years is really important. I think VF right now needs someone who can reinstill confidence with the market and with investors, and that's why you've seen their PE multiple go from being over 20 times historically to now less than 10 times because the market's really lost confidence. And I think they need someone who can bring that confidence back.
And Janine, just quickly, you kept your neutral rating on this stock after the announcement. What would you need to see to bump you up to a buy?
I think we need to start to see some green shoots within the Vans brand, which we really think is key to the turn. And I think the negative here is that even with a new leader in place, the product development cycles for footwear are very long. They're about 18 months. We also know that we're in a challenging macro environment. And even more so than that, we're in a challenging wholesale selling environment, whereas the retailers are buying their orders very, very conservatively, just knowing that the consumer is pressured. So what we really need to see is some signs of a turn, knowing that this will probably be somewhat of a lengthy process. Don't think it happens overnight. I think this is more of a 1 to 2 year turn at this point, even with new leaders in place.
All right, good place to end it. Really appreciate it, Janine. That is Janine Stichter. She is over at BTIG. Coming up, could the Fed have gotten a handle on inflation if they had hiked earlier? We'll get into it next. This is Bloomberg.
Thing in life I've often said is to be happy, but you seem like a very happy person.
It's like nature. Nothing ever stops. So you could be super happy in 1 minute and then something happens. So it's just living. It's the joy of life.
For any young woman that's watching this, wants to be the next Diane von Furstenberg, what would you recommend?
I think the most important thing in life is the relationship you have with yourself. Once you have a good relationship with yourself, any other relationship is a plus and not a must. And the second advice is to be as true to yourself as you possibly can. And you have to accept and own things you may not like. But the more you could be you, the happier you will be.
Good morning. This is Bloomberg Surveillance. Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
All right, think about this for a second. Even if the Federal Reserve had begun raising interest rates 9 months earlier than it did, U.S. inflation, it actually wouldn't be any lower today than it is now. That's according to a new model from Bloomberg Economics, which actually makes the case here that, well, some of those lagged effects, maybe we've been making a little bit too much of it. David Wilcox is joining us right now. He's Bloomberg's director of U.S. economic research, who published this report. And this has to be, at least here in the newsroom, David, probably one of the most talked about things on the Bloomberg terminal today. Let's go back in time here, because the general consensus, at least in the markets, is that the Fed started the rate hiking cycle way too late.
Yeah, that's right. That's been the predominant critique. And, you know, with the benefit of hindsight, I'm sure that people at the Fed would have loved to have moved earlier. It turns out, though, that the Fed's forecast actually stacks up rather well with the consensus view. The Fed was not better than, but also they weren't worse than the consensus. We looked at 39 forecasts that were submitted to Bloomberg Economics. Every single one of them was too optimistic about where inflation would go. The Fed was in the middle of the pack, but everybody else missed it too.
I mean, David, is there an argument to be made that, okay, even if inflation maybe would be at the same place that it is now, maybe the Fed would somehow be less behind the curve than it's found itself?
Yeah, I think there are two important points that come out of our analysis of this situation. First, earlier action probably would have shaved off the peak from inflation. So instead of a peak rate of about 8.6% CPI inflation, we would have gotten something about a percentage point less than that. So in the neighborhood of 7.5. That's not nothing, but it still isn't a game changer. We still would have had the biggest inflation surge in a generation since the 1980s. The second thing to come out of this is that unless the Fed had actually taken rates on a stronger, higher, longer trajectory than they actually pursued, we probably would be in about the same place today. They would have reaped a credibility dividend if they had moved earlier. They would have looked awfully smart. They might have saved some of the real hardship that were inflicted on American households, but we still would have had a serious inflation problem.
David, there's been a lot of folks now looking at the drop that we've seen, at least in headline inflation core, whatever we want to take. I'm just going to use headline CPI just to keep it simple. So we go from 9% plus or whatever it was down to 4% roughly now today in basically a year's time. There seems to be an argument out there made by folks in the market and even economists that a big part of that drop can't necessarily be attributed to rate tightening alone. Do you buy that?
Oh, I think there's a variety of developments that are involved there. Certainly, we've gotten some tailwind from lower energy prices, and that probably has relatively little to do with the rate hikes from the Federal Reserve. The Fed's job, though, is to control inflation without excuses. They need to take responsibility for the whole pie. They can't slice it up and say, well, we're not going to pay attention to that piece because that's not subject to the influence of higher interest rates. They have to deliver on inflation performance from the 30,000-foot level. That's why you see Chair Powell yesterday again and today this morning re-emphasizing their commitment to bringing inflation back to the 2% objective. No ifs, ands, or buts.
David, I do want to get your thoughts on what we did hear from Jay Powell this week, but we do have some breaking news we need to get to in conversation right now with David Wilcox. But we do want to get you an update right now on those passengers on that submarine that went down to see the wreckage of the Titanic, a submarine that had been lost. And now we're learning that the company that operates that submarine, OceanGate, says it believes that all the Titan submersible passengers have been lost. Once again, this is the submersible that we've all had our eyes on, a huge rescue mission off the western coast, the eastern coast, of the United States. A mission, of course, where several folks went down in this vessel to see wreckage of the Titanic and were never heard from again. Those rescue efforts, we're now learning, are starting to be called off as OceanGate says it believes the Titan sub passengers have been lost, Katie.
And And we will continue to follow that story. But on the topic of inflation, David, looking through your model, it's interesting. You write that to head off the inflation problem altogether, according to the model, the Fed would have had to put the economy through a very sharp recession. And where we are now, again, keeping it simple with headline CPI, is that still the needed medicine to really get us back to that 2% target?
First of all, the truth of the matter is nobody knows. We're still in really unfamiliar territory here. For the past 3 years, the U.S. macroeconomy has been behaving in very unusual ways. It's not clear that we're back to a normal economy yet. I think the view is correct that says we've probably had the easy part of the disinflationary journey from 9 to 4. Getting from 4 to 2 is going to probably be a hard grind, and it may well involve some increase in the unemployment rate. That certainly is what Bloomberg Economics is calling for in our outlook.
All right, David, really appreciate the time. That is David Wilcox. He is Bloomberg's Director of U.S. Economic Research. Let's now head back to the Bloomberg Technology Summit in San Francisco. Let's listen in on San Francisco Mayor London Breed.
Different than what it currently is. It could be a place where we can even tear down the whole building and build a whole new soccer stadium. We can create lab space or look at it as, you know, a new company in some other capacity. I mean, I know Brian Chesky is coming up here from Airbnb. He took the old design center where a lot of jewelry was sold. It was a whole nother use, and created his whole headquarters at the Showplace Square. So I think we have to start reimagining what downtown can be, rather than, you know, what people are saying, oh, this store is going away, that store is going away, this is no longer. Well, no one's talking about the fact that luxury brands are expanding. Yves Saint Laurent and Chanel and all these companies are expanding. So let's look at what's possible rather than dwelling on the stories of another store that there are a lot of people who may not even shop in those places.
Okay, so reimagining. Brian Chesky is next on this stage. Yeah. What do you want from the leader of Airbnb, from Mark Benioff, whose giant Salesforce tower is very empty? What do you want from these people whose tremendous wealth was generated in this city? What do you want to see?
So part of what I want to see are people who are committed to San Francisco and doing a couple of things. I want to see are people who are committed to San Francisco and doing a couple of things. Look, we know that before the pandemic, people were standing in line waiting. San Francisco has a cap on the amount of square footage that can be allocated for office space. People were waiting in line for it, and now it's changed and it's shifted. So we need to shift.
Yeah, 30% vacancy.
And part of what I want people to do is start being even more creative than they have and thinking about the possibility to utilize space in all parts of San Francisco differently. That's number one. Would I like for everyone to come back to the office 5 days a week? Of course I would. But is that going to happen? Probably not. So let's make some adjustments to do everything we can to reimagine what parts of San Francisco can be and how we can recommit ourselves to, you know, making sure that not only our companies grow and thrive in this city, but how do we get other.
And you're listening there to London Breed. She is the mayor of San Francisco. Of course, we talk about the epicenter of the tech sector in a city that's been reeling with the fallout from the pandemic and some of those tech companies and workers dispersing across the nation. It's part of our Bloomberg Tech Summit, and that does continue. You can catch it on the Bloomberg terminal by typing live go to hear more. In the meantime, we're
This is Bloomberg Business Week. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news as it happens. Bloomberg Business Week with Carol Masser and Tim Stenevec on Bloomberg Radio.
Very good afternoon, everybody. It is Thursday, June 22nd, 2023. Carol Masser along with Matt Miller. Tim, as you know, is on leave. We're live on YouTube, Bloomberg Originals, and of course in our Bloomberg Interactive Brokers studio. And obviously, Matt, we're watching and tracking these headlines involving the Titan sub, and it does look like OceanGate, the company who owns it, says that the passengers have been lost. 5 passengers who went missing Sunday. There's been a search, a global search, if you will, in terms of the involvement off the coast of the United States. But nonetheless, that's the headline that's been crossed. We are expecting a press conference from the U.S. Coast Guard out of Boston.
Yeah, it's been a story that I think has truly been gripping the nation. You know, I'm looking for updates every few hours, and we were all sort of counting down the amount of oxygen they had left. It's unclear as to still unclear as to what happened, and I think many people want answers. That's what we'll be looking for in this press conference, as well as maybe some closure in terms of, you know, the sadness involving the loss of life.
Right, exactly. It's been a news story for so many of us, but let's remember there are families and friends involved with those 5 members who are on the sub. So as soon as that press conference begins, we will certainly take you there live as expected. In the meantime, certainly in the financial world, the business world, we have been thinking about Jay Powell again, reminding us about interest rate policy and the plans for higher rates. So we're going to dig into that with our TV team. We're also going to get into what was, I think, like a wait what moment this morning when Ford and that big money loan out of the government.
Truly unbelievable. I mean, I remember covering Lufthansa when they got a $10 billion loan from Germany, and that was off the charts already. That was a pandemic thing, and this is more of a preparation for a coming battle.
Yeah, exactly. So we're going to break down that story. It's also the Bloomberg Big Take. We're going to get into that. We're also going to get into what seems like the world's obsession, not with AI, everybody, but with India. All right, right now, over to our TV colleagues, Romaine and Katie. Countdown to the close starts right now.
Countdown to the close. Bloomberg's comprehensive cross-platform coverage ahead of the U.S. market close starts right now.
This is the countdown to the close. About 60 minutes left to go here in the trading session. Romaine Bostic alongside Katie Greifeld. We're joined right now by our colleagues, Carol Masser and Matt Miller. Welcome to our audiences across Bloomberg Television and Radio Originals, and those folks streaming on YouTube. Carol Masser, let's get right to the markets real quick here. This is actually a bond story today. A lot of hawkish commentary by central bank makers, policy makers, and that appears to be shifting some of the sentiment out there, Carol. But actually, before we get to that, we unfortunately have to get to a very somber story here, now learning the fate of those folks who are on that submersible that went down to see the Titanic. Let's listen in.
Horizon Arctic discovered the tail cone of the Titan submersible approximately 1,600 feet from the bow of the Titanic on the seafloor. The ROV subsequently found additional debris. In consultation with experts from within the Unified Command, the debris is consistent with the catastrophic loss of the pressure chamber. Upon this determination, we immediately notified the families. On behalf of the United States Coast Guard and the entire Unified Command, I offer my deepest condolences to the families. I can only imagine what this has been like for them, and I hope that this discovery provides some solace during this difficult time. Additionally, we've been in close contact with the British and French consuls general to ensure that they are fully apprised and that their concerns are being addressed. The outpouring of support in this highly complex search operation has been robust and immensely appreciated. We are grateful for the rapid mobilization of experts on the undersea search and rescue and we thank all of the agencies and personnel for their role in the response. We're also incredibly grateful for the full spectrum of international assistance that's been provided. The ROVs will remain on scene and continue to gather information. Again, our most heartfelt condolences go out to the loved ones of the crew. We'll now take questions.
John, what other debris have you found? John, what other debris have you found? Can you talk about the delay in reporting the vessel missing and what impact that had on the recovery?
This was a incredibly complex case, and we're still working to develop the details for the timeline involved with this casualty and the response. And so we'll provide that information.
James Matthews from Sky News. John, what other debris have you found? And have you found any trace of those who were on?
So this is an incredibly complex operating environment on the seafloor, over 2 miles beneath the surface. And so the remote operating vehicle has been searching, and it is highly capable. And we've been able to classify parts of the pressure chamber for the Titan submersible. Let me refer to one of my undersea experts here, Mr. Paul Hankin, to talk about the nature of some of the debris.
Thank you, Admiral. So essentially, we found 5 different major pieces of debris that told us that it was the remains of the Titan. The initial thing we found was the nose cone, which was outside of the pressure hull. We then found a large debris field. Within that large debris field, we found the front end bell of the pressure hull. That was the first indication that there was a catastrophic event. Shortly thereafter, we found a second smaller debris field. Within that debris field, we found the other end of the pressure hull, the aft end bell, which was basically comprised of the totality of that pressure vessel. We continue to map the debris field, and as the Admiral said, we will do the best we can to fully map out what's down there.
Can I ask this? Admiral, can I ask you? Thank you very much. Go ahead. It's a very difficult question to ask, but it will be an important one for the families, of course. What are the prospects of recovering the bodies of the missing crew?
So the questions was related. I'm restating the question from the standpoint of sometimes it's hard to hear the question here. What are the prospects for recovering crew members? And so this is a incredibly unforgiving environment down there on the seafloor. And the debris is consistent with a catastrophic implosion of the vessel. And so we'll continue to work and continue to search the area down there, but I don't have an answer for prospects at this time.
Admiral, Tom Costello with NBC News. Is there any suggestion? Sorry, any suggestion at all that the sub itself collided with the wreckage of Titanic, or that instead it might have imploded above the wreckage and then rained down nearby?
So the question was, is there any question as to whether or not the sub collided with the Titanic or whether it imploded above and debris field created from that? So the location of the Titan submersible was in an area that was approximately 1,600 feet from the wreck of the Titanic. I have an expert here that is familiar with that area and can talk about the debris field and what the debris field indicates in terms of where the casualty may have occurred.
Rear Admiral, really quickly, can you tell me when that massive fleet will be called back?
Hang on a second. The expert voice is coming up to answer the question.
Thank you, Admiral. So the question is, where does the wreck lie in relation to the Titanic? I didn't hear the Admiral's answer. I think 1,600 feet. Was that correct, Admiral?
Yep, you got it.
So that's off the bow of Titanic. It's in an area where there is not any debris of Titanic. It is a smooth bottom. There, to my knowledge and anything I've seen, there's no Titanic wreckage in that area. And again, 200 plus meters from the bow, and consistent with the location of last communication for an implosion in the water column. And the size of the debris field is consistent with that implosion in the water column.
Well, if I can ask you a question, in terms of the timing here, you say that this was a catastrophic implosion, and I know it's early on, but is it your estimation that this happened right at the moment when they lost contact, an hour and 45 minutes after their descent?
So the question was about the timing of the catastrophic implosion. Right now, it is too early to tell with that. We know that as we've been prosecuting this search over the course of the last 72 hours and beyond, that we've had sonar buoys in the water nearly continuously and have not detected any catastrophic events when those sonar buoys have been in the water. So,
Can you describe what happens from here, sir, in the next days and weeks?
The question was, what happens from here? What's the next phase? And so right now, again, our thoughts are with the families and making sure that they have an understanding as best as we can provide of what happened and begin to find some closure. In terms of the large process, we're going to continue to investigate the site of the debris field. And then I know that there's also a lot of questions about how, why, and when did this happen. And so, you know, those are questions that we will collect as much information as we can on now. While the governments are meeting and discussing, you know, what an investigation of this nature of a casualty might look like. This is something that happened. I'll just remind everybody. This is something that happened in a remote portion of the ocean with people from, you know, several different countries around the world. And so it is a complex case to work through, but I'm confident that those questions will begin to get answered.
Is there any suggestion that time factors, speed, anything could have prevented this or saved 5 people on board, or is this quite simply a catastrophic accident?
The question was there any suggestion that time factors may have played a role or a consideration in water throughout, and did not hear any signs of catastrophic failure from those. And so we're going to continue to investigate, or we're going to continue to document the information there and understand, based on all the information we have, the timeline.
What does it mean for the resources required for the investigation? Which ships will be pulling out and coming in?
So the question was, what are the resources required for the investigation, and which ships will be pulling out and staying in? And so it's too early for me to talk about an investigation. That's a decision that's going to be taken outside of the search and efforts that I was leading. But we do have a number of vessels. We have 9 vessels on the scene right now. We had medical personnel on scene. We had other technicians on scene. And so we will begin to demobilize personnel and vessels from the scene over the course of the next 24 hours. But we're going to continue remote operations on the seafloor. And I don't have a timeline for when we would intend to stop remote operations on the seafloor at this point.
As a result of this, do you think there should be changes in the way these are safety rated or inspected so that this won't happen again?
Yeah, the question was essentially about do you think that there should be changes in safety ratings or inspection for these standards? I know that there's a lot of questions about why, how, when this happened, and the members of the Unified Command, have those questions too as professionals and experts that work in this environment. And this is an incredibly difficult and dangerous environment to work in out there. But those questions about the regulations that apply and the standards, that's going to be, I'm sure, focus of future review. Right now, we're focused on documenting the scene and continuing the subfloor.
All right, everybody, you have been listening to a live press conference there in Boston. That last voice, Rear Admiral John Mauger of the U.S. Coast Guard, several people speaking, but Matt, confirmation essentially that that remotely operated underwater vehicle did find 5 very significant pieces of debris. And so the assumption is that they obviously have found what was the Titan and talking about a catastrophic implosion in terms of what ultimately happened. They're going to continue to explore that debris field, but lots of questions still to be answered.
Yeah, people were asking about the recovery of remains, and the Admiral saying that he's not exactly sure how this is going to proceed. They've only just found the debris field about 1,600 feet off the bow of the Titanic, and now they're going to have to make decisions as to whether or not they can deploy those kind of resources, because it's so difficult, as you can imagine.
So deep, so difficult.
Even to get to that depth. If you're down, I think 13,000 feet is the depth at which the Titanic is sitting, and that should be almost 20,000 pounds per square inch of pressure, which is why it's so difficult. There are so few vehicles that can even go that deep. And that's also why it's so dangerous to operate down there in a research or a tourism perspective.
5 people that were in the Titan who went missing on Sunday in that dive to the Titanic. All right, folks, we will continue to monitor, of course, and you can head to Bloomberg.com too if you want further details, but we will stay on that story and bring you any more headlines as they are known. In the meantime, I do want to welcome you to Bloomberg Business Week. Carol Massar along with Matt Miller. Hey, there was definitely, though, a business headline this morning that definitely caught our attention, and that had to do with the Ford Motor Company. And we're calling it the Bloomberg Big Take on this Thursday because it has to do with one of the biggest loans to a U.S. car maker in more than a decade. Kind of harkens back to the financial crisis when we saw the auto bailout. So let's get to it with Bloomberg News auto reporter Keith Naughton. He's on Zoom in Detroit. Hey, Keith, nice to have you here. Thanks for your patience. A lot going on, as you know. Tell us about this loan and what program and how did Ford get it? How were they singled out?
Yeah, so it's Ford and its South Korean battery partner SK On, and it's for 3 battery plants that they are building, 2 in Kentucky, 1 in Tennessee, as Ford kind of scales up to be building, their target is to be building 2 million EVs annually by the end of 2026, up from about 130,000 last year. So it's a big get. That investment Ford was already making in these 3 battery plants plus a EV assembly plant in Tennessee was $11.4 billion. So you can see this loan covers almost all of that, even though the assembly plant isn't part of it. So it's a big financial windfall for Ford. The idea from the Department of Energy and the Biden administration is to try and catch up to China's very sizable lead in electric vehicles and batteries.
It is a massive amount of money, though, for a government to lend to a company, to a for-profit organization. $9.2 billion. The only thing I can think of that comes close is the 10 billion euros that Deutsche Lufthansa got from the German government during the depths of the pandemic, and that was controversial at the time. Has the government given loans of this size, Keith, to your knowledge, to any other companies?
Well, I think we should keep in mind the bailout of General Motors and Chrysler. General Motors was $50 billion and Chrysler was $12.5 billion. So the government has bailed out failing automakers in the past. That's not the case here. Ford is certainly not a failing automaker. It's thriving. But I think it speaks to the Biden administration's focus on really taking on China, which has this huge lead in EVs and batteries. 80% of the world's lithium-ion batteries come out of China. China controls the minerals, the processing, and they have the largest, by far, EV market in the world in China. The Biden administration views this as, strategic, and it's strategic on many levels, not just economically strategic, but also from a security standpoint. It's very much a geopolitical issue. So that's why they're investing so much. Last year, they gave General Motors and their South Korean battery partner, LG, a $2.5 billion loan, but clearly the stakes are going up.
You know what's crazy? And Matt and I did this story earlier, or a couple of weeks ago from Bloomberg about A123 systems, because here we are playing massive catch up with the Chinese, Keith, as you well know, right? When it comes to battery technology, we had it and then let it really go away and slip through our hands. And here we are spending big time to catch up on it. It's unbelievable.
Yeah, I mean, that was the subject of Gabby Coppola's really great Business Week cover story, how A123, a company, born in America with American technology, went belly up early on in the EV development because there just wasn't enough of a market there. And China swooped in and bought them up. And lo and behold, they become the leader in battery technology that was born in America. So, we find ourselves in this position. What happened is this DOE loan pot that existed, for the past 15 or 20 years, really kind of went dormant for about a decade during the Trump administration and the second Obama administration. And that was the period in which China, the Chinese government, was investing billions and billions into developing the battery infrastructure that they now lead the world in.
On the other hand, Tesla is a world leader in EV production, and they also got a loan, a smaller loan, to help them launch their first factory. I think $465 million is what I saw in your story. That was 2010. I guess with inflation, that's about $9 billion today, right? Considering the inflation that we've seen. But look at how well it worked out, right, Keith?
Right. And these DOE loans, they were going on in that time period, around the time of the Great Recession. Ford itself received a previous DOE loan for $5.9 billion, which inflation adjusted is not far off the loan that they're receiving now. It's about $1 billion less if you adjust for inflation. And they're using that to improve the fuel economy of the cars coming out of their factories, multiple factories. Now it's all about EVs and batteries. If Tesla hadn't received that loan, back in 2010, who knows if they would be the world's most valuable car maker today. Elon Musk has certainly said that loan was essential.
Keith, major oops, by letting it slip through our hands years ago here. Having said that, if you believe in capitalism, shouldn't Ford just kind of figure this out on their own? This is their business going forward. Shouldn't they have to just kind of spend the money?
Carol in there with the free market capitalism perspective. I like it.
Just saying.
I mean, it's a choice, Carol. I mean, right now, China and Europe are investing tons of government money to develop an EV market. Remember, it's still a nascent market, particularly here in the United States, which is the slowest of the major markets to adopt EV technology. Still, fewer than 1 in 10 vehicles sold in the United States is an electric vehicle. We're still very much an internal combustion engine, gasoline-fueled economy. And to change that, to turn that giant ship around, it costs a lot of money. And you can say just let the free markets do it, but right now the United States is behind.
Yeah.
And they're behind in large measure because China and Europe put so much government money into it.
Well,
So
look
you
at what
just
the
let
free
that
markets
go?
did for charging stations. Basically nothing outside of Tesla's supercharger network.
Right.
So, hey, Keith, you mentioned a pool of money, and so I'm wondering, is there any more after this? Who else gets cash besides Ford?
Yeah, there's a $400 billion pool of DOE money. So this is just the start. Others will get money. As I said, General Motors and its South Korean battery partner already have received a loan. There's more to come. You know, this is a high priority for the Biden administration. You know, it was also part of the Inflation Reduction Act. It was part of the infrastructure bill. So they're putting all sorts of money into developing batteries, battery infrastructure, charging, and developing an EV consumer market in the United States with the $7,500 tax credit.
Interesting story. And I was just putting out a different perspective. I'm just saying.
I like it. We're still allowed to share different perspectives.
No, I know.
But
and
not for much longer.
And wasn't it years ago that the government got involved with semiconductors, right, initially to kind of jumpstart it? Anyway, Keith Naughton, always fun to check in with you and always informative. Keith Naughton is auto reporter at Bloomberg News on Zoom from Detroit. Read this story. It is the Bloomberg Big Take, It's among the most read on the Bloomberg, but that's a massive investment.
NI Big Take Go.
Yes, indeed. All right, you are listening and watching Bloomberg Business Week. Let's head on over to Charlie Pellet with a check on your top business stories on this Thursday. Hey, Charlie.
Hi, thank you very much. And here's what's going on. We are looking at mixed markets right now, but among those automakers, Ford shares, they are higher up now by 1.1%. GM in the red, down 1.2%. We have got Stellantis shares trading lower by 1.2%, and Tesla up now by 1.6%. Bond yields are climbing after major central banks warned about the potential for more interest rate hikes, with officials signaling they are nowhere near ready to declare a victory over inflation. Two-year yields have hit the highest since March, as Jay Powell said the U.S. may need one or two more hikes in 2023. Also this morning, the Bank of England accelerated its tightening and warned it may have to hike again. 10-year yield right now, 3.79%, but the two-year, 4.78%. S&P up 8. We're looking at a mixed market now, higher by about 0.2%. Dow Industrials down 30, a decline there of 0.1%. NASDAQ up 95, a gain of 0.7%. Spot gold down $18 the ounce, down 0.9% to $19.14. Big move for crude oil today. Now it's $69.44 a barrel, down 4.3%. Briefly, J.P. Morgan Chase will pay a $4 million fine to settle SEC allegations that the bank mistakenly deleted millions of electronic records, leaving communications unavailable to regulators in a dozen investigations. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Carol Master along with Matt Miller. Matt, of course, in for Tim here on Bloomberg Business Week.
Even though
what?
I was up until 2 o'clock in the morning.
I have to say, when I was reading in this morning, and I'm like, I knew you went to the Dead concert or the Dead and Company concert. And then I'm like, is this 2 in the morning? So you got home and you were like reading stories.
I got home and I wanted to read in because I knew I'd be tired when I woke up. My daughter this morning said, "Daddy, are you tired?" Yes. Yes,
It's painful. It's painful. Painful is some of the relationships, geopolitical relationships that are happening around the world. And I've got to say, what's interesting, though, as some get more stressful, China and the world, others kind of move in to fill in the spot, and I'm talking about India, because we've seen Indian Prime Minister Narendra Modi here in the United States talking to CEOs, talking to President Biden. So we want to talk a little bit more about the India boom, if you will. Bloomberg News White House reporter Justin Sink is with us on the phone from our D.C. bureau, and Chris Anstey is with us, Bloomberg News senior editor on Zoom in our Boston bureau. And Chris, I do kind of want to start with you. India does seem to be the world's favorite dance partner. Why India and why now?
Well, for one thing, it's big. They've got a bigger population than China. So the thinking is that here is a very large supply of labor that could, under the right conditions, serve as something of a replacement for China. Obviously, a lot of questions about India's infrastructure, India's ability to deliver for foreign manufacturers, but that's the first thing. Second thing is, as you're going to hear from Justin in a second, there's a lot to be made about this democratic, shared values kind of identification with India. Some questions about that, but here's a country that's big. It's a constitutional democracy, and it also is no long-term friend of China. There have been clashes on the border between India and China. So on the theory of the enemy of your enemy is your friend, there is that dynamic going on as well.
Justin, weigh in here on the shared values that we have. I mean, it's become clear over the past few years that we don't necessarily want to be cooperating with countries that use slave labor, that kidnap dissidents, that dismember journalists, even though, of course, we do a lot of business with countries that do all those things. Is India kind of in the clear in that sense?
Well, it's a real kind of tricky situation for the United States as they approach this, because while India obviously is far more democratic than some of the countries that you alluded to, they've also, the government of Prime Minister Modi has sort of initiated crackdowns, particularly targeting Muslim minorities, but towards opposition leaders and journalists in the country that have been jailed. And we saw today in the press conference, which was one of the first press conferences that Modi had done in nearly a decade, he was pressed about these issues, and it is a source of some tension in the relationship. President Biden, I think, with eyes towards cultivating that relationship and making it better, focused or spoke at some length about how there were, strains on democracy in both countries. Modi, for his part, sort of dismissed the criticism wholesale and said he was surprised to hear, any of these complaints. But there's a lot of pressure for Biden among Democrats and among activists to push harder on India as they cultivate these economic and military ties that are really important to President Biden's foreign policy, to not leave human rights completely behind.
You did say it was the first press conference, Justin, that Prime Minister Modi has done in a decade. Is that right?
Do you mean in America or like anywhere?
No, like at all.
Okay.
He hosts a radio show back at home, but press conferences are very rare involving the Indian Prime Minister, and this was something of a conflict. We got the schedule earlier this week, and there was no press conference on it, though it's typical and customary is that you do a what's called a 2 and 2, which is two reporters from each nation have a chance to ask both the U.S. president and whatever foreign leader is there for a state visit a question. You'll notice that today it was a 1-on-1, so just one U.S. reporter asked a question to one Indian reporter, and that's a signal that even that issue was sort of a source of tension and some diplomatic negotiations here ahead of the state visit.
Hey, Chris, I wonder about the wealth of Indians. You have mentioned, obviously, it's huge, in terms of the amount of people they have. But the story in China for years has been how many millions or hundreds of millions of people they've pulled out of poverty, thus making them, able to buy an iPhone or to finance a Tesla. Is India in a similar situation or on the same trajectory even?
This is what's been interesting. Just the past, 1 or 2 years, you've had a number of signs that suggest that India may finally be getting its act together. For decades, they had right kind of in their neighborhood the model for development. China, the development you just alluded to, was itself following a model pioneered by Japan, South Korea, Taiwan, Singapore, Hong Kong, these newly industrializing economies in the post-war period in the 1960s, 1970s, investing in manufacturing, investing in exports, welcoming foreign capital, and using that as a launch pad for growth. And it's been extremely successful for all of those countries I mentioned. India, for long, said, no, we're going to go our own way. We're going to pursue this semi-socialist path. You used to see, there were bans on many foreign companies, including Coca-Cola, in the 1970s. You couldn't get a Coke if you went to India. And that has really changed. You've seen under Modi a welcome to foreign companies, a welcome to foreign capital, and somewhat surprisingly, the governments have been dedicating an increasing share of government spending to infrastructure to build out the manufacturing base.
Hey, Justin, saving 25 seconds here. Russia, though, is a sticking point, correct?
Yeah, I mean, India has been pretty reluctant to impose the type of deep sanctions that other countries have in the wake of the war in Ukraine, and in fact has taken real advantage of other countries refusing to buy their oil. They passed even Saudi Arabia in terms of how much oil they imported from the Russians as a signal last month of just sort of how much of that is coming in.
All right, listen, guys, thank you so much. Can't tell you how much we appreciate being able to do this story with you. You are listening to Bloomberg Business Week. That, of course, was Justin Sink and Chris Anstey. All right, let's get a check on world and national news. Off to D.C. and Nancy Lyons. Hey, Nance.
Thanks, Carol. The search for a missing submersible with 5 people on board is now over. Coast Guard Rear Admiral John Maugert shared the sad news a short time ago.
This morning, an ROV, or remote operated vehicle, from the vessel Horizon Arctic discovered the tail cone of the Titan submersible approximately 1,600 feet from the bow of the Titanic on the seafloor. The ROV subsequently found additional debris.
Admiral Maugert says they believe there was a catastrophic implosion of the vessel. As you've been hearing here on Bloomberg, Indian Prime Minister Narendra Modi is in the U.S. on his first official state visit. It's a high-profile affair with a banquet at the White House and address to Congress. President Biden says the two nations share a commitment to freedom.
I've long believed that the relationship between the United States and India is will be one of the defining relationships of the 21st century.
Biden and Modi announced a series of defense and commercial deals to improve their economic ties. Wall Street Journal reporter Evan Gershkovich, who has been detained and accused of spying in Russia, will spend more time behind bars. Today, his latest appeal was rejected. U.S. Ambassador to Russia Lynn Tracy spoke to reporters.
This was a procedural hearing appealing the conditions of his continued detention, and we were extremely disappointed by the denial of his appeal.
Ambassador Tracy says Gershkovich is innocent and is being wrongfully detained. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Nancy Lyons. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 3:40 on Wall Street. We do check markets all day long at Bloomberg. We've got the Dow lower, S&P, NASDAQ, both pushing higher. Let's head right over to the first word breaking news desk for today's afternoon call. Here he is, Bill Maloney.
And good afternoon, Charlie. That's right. U.S. stocks trading mixed right now with the Dow down 42 points. S&Ps are higher by 11. And NASDAQ is climbing by 110. The U.S. 10-year yield at 3.79%. Gold is down 18. Oil is fading. And Bitcoin is trading higher by 0.4%. Of the main 11 S&P sectors, leaders were consumer discretionary and tech. Real estate and energy were under pressure. And leaders to the upside in the Dow, Merck, Microsoft, and Salesforce, while Boeing fell 2.8% and led to the downside. In the tech space, Amazon gained 4%, trade to the highest level since September, and broke out of a range. And after earnings, FactSet fell 5%. Wrapping things up, Smith & Wesson reports after the bell. Live from the first breaking news desk, I'm Bill Maloney. Charlie?
Okay, we thank you very much, Bill Maloney. And to hear live breaking news over your Bloomberg, type SQUAK, S-Q-U-A, on your Bloomberg terminal. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no. Who's gonna drive you home? Honey, please, I'll do the driving. Drive on. Excuse me, I want to drive. It's
the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
All right, everybody, just got about 17, 18 minutes left in today's trading session. Are you yawning? No. Are you? Come on.
No. Okay.
All right, everybody's watching on YouTube and Bloomberg Originals. That was a yawn.
I was just refreshing my lungs because I only got about 5 hours of sleep. So it's okay.
What did your daughter say to you this morning?
Daddy, are you tired?
Yes, indeed. I feel like the markets are a little tired when it comes to the bounce that we've seen in a big way, right? Like on the equity side of things. We've got, as Charlie mentioned, a little bit of a gain on the S&P. NASDAQ, really the outperformer once again, up 0.8%, Dow a little bit lower. But as Romaine said earlier, it really does seem like it's a rate story again with Jay Powell back up on Capitol Hill. Did have some economic news, so let's get to it. A really cool guest, Veronica Clark, economist over at Citigroup. She's with us on Zoom in New York City. Veronica, I love that we have you here as we count down to the close, because I really feel like in terms of equity markets or financial assets, we really have to have a good understanding about the economic backdrop to kind of understand maybe where financial assets go from here, where they should go from here based on the fundamental economic backdrop. So where are we?
Yeah, it is a really confusing backdrop right now, unfortunately. I mean, we're all waiting for this recession that still is not happening. And of course, with that recession not happening, we're not getting the slowdown in spending or activity, and that means inflation is still high. That means the Fed is still raising rates. It is a very confusing backdrop. But of course, we had Powell today and yesterday. This is still a Fed that's focused on raising rates and slowing activity a bit more.
So what kind of rate increases do you expect going forward? Are we going to see the two that were indicated in the dot plot? Or, as Raphael Bostic put it, are we going to see passive tightening that doesn't include actual rate hikes, but just a reduction of inflation to bring the real rate up?
Yeah, those were a bit dovish comments from Bostic, but I think we are with most of the FOMC members right now with the committee and seeing 2 more rate hikes. We'd actually seen that even ahead of last week's meeting, had been penciling in potentially that they could have even raised rates last week. Of course, we didn't get that, but we've been penciling in a 550, 575 terminal rate for this year for a while. Of course, the median dot last week did come up to that range. So we are still penciling in 2 more hikes right now, thinking that they'll be in July and September, but of course a lot of variability on when we might get them. But yeah, still think that the rates are rising a bit more just because, inflation is still pretty persistently high.
How often do you guys say maybe Jay Powell might get this right? Or how many times do you say he might just get this wrong?
Yeah, I mean, I think the Fed is doing the right thing here. They were, potentially a bit behind the curve, when we had inflation coming up. But you really, I think it does need to be inflation is still the number one focus. And we heard that from him, today and yesterday. They have met their, mandate on the employment side. We have a very low unemployment rate. We're still running, monthly job gains that surprise to the upside every month. 339,000 in the last, report. But we are not there on the inflation side of things. We do still have persistently high inflation. So I think they're doing the right thing, and that has to be your focus right now.
I got an email from Torsten Slok this morning over at Apollo showing the average new mortgage payment across the country. And it is a shocking chart. I had to message him to make sure the data is correct, because we averaged between $1,000 and $1,500 over the last 20 years. And now we're looking at a $3,000 average monthly payment for a new home purchase. Is this an environment in which the consumer is going to be able to keep up?
Yeah, it is. It is pretty incredible. I mean, housing affordability is not good right now. Obviously, that's partly due to higher mortgage rates, but it's also because home prices, they did come down a little bit, but not that much, especially relative to the last 3 years of really substantial home price increases. We of course had some existing home sales data out this morning. Those median prices, on a seasonally adjusted basis, are actually really rising again. We saw that in the May data. I think it's just an issue of, housing is still very unaffordable, but if you did lock in a lower mortgage rate over the last couple of years, which a lot of people did, then you're not going to sell that home. You're not going to sell your home. You're not going to give up that rate. So supply of housing is still really constrained, which of course we know if from the last 2 years, if supply is constrained, that means upward pressure on prices.
Yeah, we've done a bunch of stories. I think everybody has, right? This, here's it. U.S. home resales barely rise as inventory constraints worsen. I mean, we know. I have a lot of relatives. They're not leaving their homes because they've got really low rates. Having said that, Veronica, I'm curious. What's more important, though, in terms of economic growth? Is it that the labor market stays strong and people keep on working, or is it that people are buying homes?
Yeah, it is really fundamentally going to come down to what happens with the labor market. We've been surprised, I think, on the degree of excess savings that was built up over the pandemic, that how much that's been able to come out and support spending, come out into the economy. But the main thing that will continue to drive spending, will continue to have people wanting to buy homes, to at least an extent, is if people still have a job. That is the number one issue is as long as the labor market is still just as strong, then there's really not a lot of that downward pressure on inflation, at least. And that's a bit of a worry for the Fed. They of course see inflation and labor market as very linked.
We have seen the initial jobless claims finally kind of jump up. I know that they keep being revised down. So the first readings are always like above 250, and then they get revised down significantly. What do you think the chances are that the labor market cracks here? And if so, how fast can it go, Veronica?
Yeah, that's really what we're all looking for now. I mean, I think we are included in this. We have an expectation, a lot of people do, for a mild recession later this year. Have been expecting it for a while. Been expecting the labor market to slow. I do think that claims data is probably the best leading signal of that. But it would be if we saw initial jobless claims trending higher week after week for a number of weeks. If the increase in claims was broad-based across states, that's really not.
Well, that's what I wanted to ask you, Veronica, right? Because the run-up has been concentrated in just a handful of states. So I'm just nationally, the U.S. states, the claims remain below the 2019 average. So if we start to see it broaden out, that's more worrisome.
Yeah, I would think so. We've seen claims higher in California. Of course, we know about tech layoffs. We've seen that in other data. So that's not too surprising. It's still there. Of course, we maybe a month or so ago had this increase in Massachusetts that turned out to be fraud. It looks like maybe that could be some issues in some other states. The last couple weeks of claims, and maybe even more so in the next couple weeks, We did get a law change in Minnesota where education workers are able to file for unemployment over the summer break.
Yeah.
So that actually is an idiosyncratic, it's not layoffs, but could mean that claims are a bit harder to interpret. So yeah, you really do want to look at the details here, see where it is.
We got to run. Veronica Clark over at Citigroup, an economist there on Zoom in New York City. This is Bloomberg Radio.
Your company news headlines on Bloomberg Radio.
From Bloomberg World Headquarters, I'm Charlie Pellet. Bed Bath & Beyond is set to sell its intellectual property and some of its digital assets to Overstock.com for $21.5 million, according to a bankruptcy court filing. The terms of the deal also include the company's internet properties and business data. Overstock shares, they're up now by 17.6%. Ford is getting a $9.2 billion loan to help the U.S. catch up with China's EV technology, all a part of the government's $394 billion Clean Energy Project initiative. Darryl Cronk is president of the Wells Fargo Investment Institute.
The Ford news this morning is all about batteries, right? And that is the constraining factor for the next step higher for the EV market, right? The electric vehicle market. The reality is China has owned the chip market and they've owned the battery market, right? And so to dislodge that or to move it to other parts of the world, both from a supply chain standpoint, but just a diversification standpoint, requires a huge amount of investment. And you're seeing that investment today.
And you can hear more of that conversation on the Bloomberg Surveillance Podcast. You can download it wherever you get your podcasts. Right now, we've got shares of Ford advancing 1%. Shares of General Motors down 1%. Stellantis lower by 1.1%. And Tesla shares, they are higher now by just about 1.9%. And those are some of the top company stories that we're following for you at this hour. I'm Charlie Pellet, and this is Bloomberg.
This is Bloomberg Business Week with Carol Masser and Tim Stenevec on Bloomberg Radio.
All right, everybody, just about 4.5 minutes left in today's trading session. Carol Masser along with Matt Miller. As you know, Matt is in for Tim here on Bloomberg Business Week. We're going to soon head over to Romaine and Katie, counting down to the close on this Thursday. In the meantime, there's a new challenge in town.
Yes, I love this story. I cannot believe, I still find it hard to believe that it's real. But I suppose if we cite sources,
you do feel like you're getting punked, like the world is getting punked on this, right?
It does. I had to check to make sure it wasn't April 1st. You know, it's far past that. But apparently, Elon Musk has kind of tongue-in-cheek challenged Mark Zuckerberg to a cage fight. And since Zuck has been training and doing like jujitsu and stuff, he is like, yeah, name the place, buddy. So...
yeah, it's
basically
has to do with, right, that I guess they're rolling. Who is it rolling out something?
Because Meta Platforms, so Facebook parent Meta Platforms is planning to launch maybe a competitor to Twitter, a direct rival to Twitter, right? Because Lord knows we need one. And Musk, I guess, put out a tweet saying, like, I'm up for a cage match if he is, lol. And then Zuckerberg responded on Instagram with a screenshot of the Musk message and the response, send me the location. The only thing that was missing is the word bro. You know?
And I guess Elon later on, some other tweets said, if this is for real, I will do it. He proposed the Las Vegas UFC Octagon as a venue, jokingly described his typical workout, throwing his children in the air, and his combat technique, lying on people in a maneuver he calls the walrus.
The walrus. If you've ever seen a picture of Elon Musk in a bathing suit on the deck of his yacht, you know that that would be a lethal move.
It's unfortunate.
But apparently he's gotten in very good shape since then. So I think they're both in really good shape. The thing is...
I don't know. I'd put my money on Zuck, I think. He's been running a mile, 100 pull-ups, 200 push-ups, 300 squats, and another mile while wearing a 20-pound weighted vest, all in 40 minutes.
That's tough. But I would pick Bezos above them all.
He is.
That guy's jacked.
Oh, my God. It's a little... yeah. Oh, my... I wonder if he gets into the fray. That would be really funny. All right, we're going to get into the fray that is known as the financial market. It's not such a fray, but anyway, we're going to break down the trade for you on this Thursday. Matt and I heading over to TV, Romaine and Katie. That's because Beyond the Bell starts now. I don't remember what...
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Katie Greifeld, counting you down to the closing bell, here to help take us beyond the bell. It's a global simulcast with Carol Masser and Matt Miller. Welcome to our audiences across Bloomberg Television, radio, and on Bloomberg Originals as well. Interesting shot, Carol, for our television audience as we came into you, as we look at the sort of the radio fishbowl that they trap you in with Matt Miller there. But at the top there, it really wasn't about stocks. It was about bond yields climbing, and that really does seem to be a big part of the story today.
Hey, it's like Jay Powell spoke or something. Yeah. In fact, he did for a second day in a row. And yeah, we certainly saw it play out in the Treasury trade. You also saw it play out in REITs today because they were definitely, the office REITs in particular, down about 3% as a whole, but names like Hudson Pacific, Office Properties, and basically he made some comments about, aware of the growing problem when it comes to commercial real estate during that congressional testimony earlier today. So that group and investors certainly noted that as well, Matt.
Yeah, for sure. So it's interesting to see that this, the big rally that we saw at the end of last week, I guess investors were taking profits over the past couple of days, but they're back in it now as we approach the close, right? We're finally heading back up. We've been bouncing up and down, but stocks look like they're up about 1/3% on the S&P. The NASDAQ doing much better than that. So maybe this wasn't a head fake the last couple of days. Maybe we're really going to see some gains.
But even still, I mean, you look at volume. We are down today about 12% versus the 20-day average on the S&P 500. So I don't know how much conviction there is to read into this rally. I'm not sure.
Well, just looking at a couple other measures, I mean, we're talking about a day where it looks like the VIX is going to settle below 13, if you can believe it. I know you're not a believer in that, Matt Miller, but how about Bitcoin? I know you're a believer in that. That's up again, about 0.8%, holding at that 30,000 level. Meanwhile, we do get the closing bells here in New York for U.S. equity markets, fastly ringing the bell. They're over at the NYSE and the Dow Jones Industrial Average, unchanged on the day. The S&P 500 up by about 0.4%. The NASDAQ Composite, that's their outperformer on the day, higher by more than 100 points, or about 1% on the day. And the relative laggard on the day, that belongs to the Russell 2000, which is going to close lower by 0.8%.
All right, Romain. So the S&P 500 just eking out a gain there by the closing bell. Having said that, there's definitely a negative tone when you look at the index. About 324 names, Matt, to the downside here. 177 actually up on the day, 2 unchanged.
Yeah, and by the way, I want to point out the relative strength index. We're under overbought, so we're safe now. We're back at 65
for now.
For those of you who often track that index, here you can see the gainers and losers on the S&P 500 in terms of industry groups: consumer discretionary stocks, communication services, so that's like the car makers, the home builders, and the streamers, all on the up and up today, as well as IT. The losers are real estate, energy, and financials, and those banks are leading the losses on the S&P 500.
All right, folks, let's get to some of the individual gainers in the Thursday session. Amazon, number 2 gainer in both the S&P 500 and the NASDAQ 100, finishing pretty much at its highs of the day, up about 4.25%. Loop Capital coming out and saying the stock could soar to $180 a share. So upping it from 140 was the previous target. Stock closing at 130.15. So some room to run certainly there. It also said, and this is on top of a more than 50% rally in Amazon shares this way.
Yeah.
Basically,
so it's 180. So the all-time high was 186, and that was like in 2021.
So it's basically saying it gets up to almost right to its all-time high. Basically, Loop Capital saying that Wall Street is mismodeling Amazon's potential to improve its retail margins, saying some other things, but nonetheless, certainly kick to the upside. Ocado Group, they have ADRs that trade here in the United States. It's a UK-based online grocer, and some news came out earlier overnight and earlier this morning. This stock up almost 32% in today's trade. A report in the Times of London late yesterday that mentioned speculation of bid interest without saying where it got the information, cites some companies, including Amazon, so a little Amazon relationship there as well. But nonetheless, this name, when it traded in London, it was up the most in about 5 years. One more, Palo Alto Networks. This is number 1 in the S&P 500 and the NASDAQ 100 today, hitting a record high, higher volume versus what we've seen over like the past 20 days or so. And you remember on Tuesday, it replaced Dish Network in the S&P 500. Stock, Matt, is up about 80% year to date, and it gained about 14% since that news that it would replace Dish in the S&P 500, Katie.
All right, let's take a look at some of the decliners. I wanted to start off with JP Morgan, the shares falling there. There was some news. JP Morgan is going to pay a $4 million fine to settle SEC allegations that it mistakenly deleted 47 million records. Not sure if that's necessarily why the stock is down 2% today. Financials broadly down, but an interesting piece of news there. Also in video, of course, the AI chipmaker darling. It's finishing just barely in the red, but I did want to highlight that, given that the stock is up close to 200% year to date. Not often that you've seen NVIDIA actually fall a little bit. And I did want to finish up with Darden Restaurants. We did get some earnings results. It was a mixed bag when it comes to quarterly comp sales. Actually, Longhorn, you had a slight miss. Olive Garden as well. Actually, I'm sorry, Longhorn was a beat, slight miss for Olive Garden. And then in their fine dining segment, actually, there was an unexpected decline. You add it all together.
Is Olive Garden the fine dining segment?
Apparently, it's
Have you
not.
never had the tour of Italy? It's pretty amazing.
It was lovely.
It's a little bit of everything.
Well, apparently people aren't really going there because, again, an unexpected decline in that segment, which I didn't know existed. You add it all together, shares off by about 2.6%.
There you have it from Katie Greifeld. No one goes to Olive Garden anymore. It's too crowded. Too crowded.
I like a yard house.
Anyway, let's just get a quick check here on what's going on in the yield space. You hit it at the top here. That has been a big driver here on this day and really the week because of all of the hawkish talk by central bankers around the globe. Higher by about 7 basis points here. On the day for the 2-year. And what I think is interesting here is you're seeing that all across the curve. So your 10-year, 7 basis points, your 20-year, 7 basis points, 30-year, 6. So this is kind of a parallel move higher across the curve. And we saw something similar a couple of days ago as well here. So it's interesting that as the bond market starts to reprice in rate expectations, reprice in economic conditions, they're doing it all across the curve. And I do wonder what sort of signal that's sending about economic conditions.
And I do wonder when equity investors at some point just say, why should I take the risk at this point? Where there's so much debate about kind of where we go from here that if I look at the Treasury trade, right, and what I can get on a 2-year or what have you, why not plow money into that?
How much of this, though, is about, central banks around the world? Remember there was the race to the bottom? Well, it seems to have turned around at this point, right? The Bank of England raised 50 basis points again today. The pound was trading for $1.28. Where is it right now? It's got to be right around there. So maybe investors were saying, why would I want to just get a measly 4.6% in dollar 2 years when I could go and get 5.1% in pound 2 years as that currency strengthens against the greenback?
It is interesting, to watch who can be the biggest hawk. I don't know, maybe we'll end up with a Bank of England terminal rate that's ultimately higher than the Fed. It'll be interesting to check when the last time that was.
But it gets to the issue, too. Obviously, these banks are just doing this willy-nilly. There is an inflation story there. We saw it, of course, with the BOE, just the day before, and you look at that resurgence in their core CPI numbers, a big part of the reason why you got that surprise 50. But I was just looking at some data crossing the terminal out of here in the U.S., and it was about that latest sale of Treasury inflation-protected securities TIPS. We had an auction Thursday. 96% of that was snatched up by primary dealers. And we talk about this idea that maybe people are coming back around to this idea that inflation isn't beat just yet. And so you do need those hedges. You do need that protection, even if you do want to, say, go after some of the riskier stuff in equity markets.
Yeah, absolutely. So maybe they're starting to buy Jerome Powell, what Jerome Powell is selling. Is that what you're saying?
Or maybe if they're not, and maybe not him specifically, Matt, but maybe they are looking at the data that the Fed's supposed to be dependent on, and they're saying that the data doesn't support pausing or even cutting.
Well, what's interesting, too, I think there was some kind of nuances, right, to what he said today, that whether it's 2 more, whether it's possibly 1, again, he's reminding us that they're going to be data dependent. He still believes that they've got to go higher from where we are.
I don't understand why Matt just didn't ask Jerome Powell this question yesterday at the Debt & Company conference.
I looked around there, and I got to say...
You were looking for him, weren't you?
Yeah. I all of a sudden, everybody at the Dead concert looked like, a Fed chair or a PE boss, or, there's a bunch of old Wall Street guys there.
Like you, right? It's just a bunch of middle-aged guys.
Can I just tell you, Matt got tired standing. And
oh, my God.
Oh, my God, Matt, you're so old now.
I need to bring a portable seat. I need to bring one of those portable chairs.
Oh, you need some supportive sneakers. That really is.
John Mayer, by the way, had to sit down for the entire second set as well.
There you go.
Oh,
it's not just Matt.
Oh, my God. And the other guys, 70s, 80s?
He was in great shape. Bobby was doing great, so,
All right, guys, that's a wrap. Our cross-platform coverage on radio, TV, YouTube, and, of course, Bloomberg Originals. We will see you again, same time, same place, at 3 and at 4 p.m. Wall Street time. Billion. That was back in 2013. Ori Levine, of course, co-founded Waze. He's also an investor in Move It. Intel bought that one for $1 billion back in 2020. And last time around he joined us, we talked about his new book, Fall in Love with the Problem, Not the Solution, a handbook for entrepreneurs. So delighted to have Ori back with us here in our Bloomberg Interactive Brokers studio. Hello. We weren't dissing you as you walked in, so forgive us. How are you?
Excellent. And yourself?
Doing okay. Trying to make sense of all the craze when it comes to AI. Can I just jump in with you? Because I feel like when you were in February...
Can I just say a thank you? Because I was using Waze yesterday
We all
on my
do.
way to Citi Field, and it got me there in a timely manner.
I drove a cab driver crazy earlier this week because he was following something else. I'm like, I'm on Waze, and here's what you're going to do. Talk to us about, first of all, do you ever regret selling it?
No, people have regrets of the stuff that they haven't done.
I think we might have talked about this, but you don't. You just move on.
I moved on. I left after the acquisition so I can build more startups, and I am very happy with the decision back then. And at the end of the day, look, when you're making a decision, it's the right decision. There are right decisions or no decisions, and this is it.
So you've got a T-shirt on that says "Fall in love with the problem, not the solution." So those on our streaming service and YouTube can see this. You've also got a book out with that title. AI, is it a problem? Is it a solution? Is it both?
Is it yet to be determined? But it's definitely a solution. We're just not clear what is the problem yet.
Well, as a startup guy, you've got to look at a technology like that and automatically start thinking of applications, right? Of ways to use it for progress or profits. What do you think about the potential of AI?
So in general, my approach would be start with the problem, right? Start with the use case and only then build a solution. I mean, this case, because the generative language is very powerful, right? And if you would ask 100 people on the street, have you tried that? Then probably all of them are going to say yes. The challenge is that if you're going to ask them, are you still using it? And very few are going to tell you yes, which basically means that we are not at product market fit yet, or it's not applicable for the consumer market, for the mass market yet. There are some cases that I would say this is awesome, right? So if you are in the business of generating content, this is going to be very helpful too. You can generate way more content based on that.
Or are you investing in it?
No, not yet. Many of my companies are actually using AI, but not the generative language yet.
Why not?
Because it was not available until recently, and now I have one company in the medical space that is actually having the knowledge and requires the language generation for that, and this is going to be a leapfrog for them.
Do you still think about, I know Waze was 10 years ago, but do you still think about navigation and the possibilities that AI could help in that space? I mean, my first thought when I heard your name and AI was, I wonder if this could help me avoid speeding tickets more often. Because that's one of the benefits of Waze is that I can see where others have pointed out that the police are waiting. So do you think AI could help at all in making Google Maps a better product, for example?
So Waze is based in a lot of cases on crowdsource on one hand and AI on the other hand, right? And so we can understand
from data, right? Constantly.
We can use we can look at different users and from their behavior understand what is going on. And so we have built AI system before we even knew how to say that, right? And I think that many companies have built an AI capabilities into their product before we actually had the generation of the language.
Do you think of generative AI as akin to some other tech development? I mean, I don't know. I think folks are have been talking about the creation of the internet. I don't know. How do you think about it?
People are saying that this is the biggest revolution ever, right? And I would say, no, wait a minute. It's not there yet. It's definitely not as big as the internet itself. It's definitely not as big as the mobile phone itself. It's definitely not as big as the smartphones, right?
Yet?
The PC.
Yet, though? Is it a yet, or is it just...
They might be yet.
Okay.
But because at the end of the day, what all the other tools that I've mentioned did is that they interconnect people. And they enable people to become better to communicate, better to access the information, better for anywhere, anytime, anywhere. And this increased the abilities of the people. Now we are looking into a system that may be able to generate content by itself, but less likely to be creative.
Well, if you're talking about falling in with the problem, all of the things that we just talked about, the internet, the mobile phone, the PC, right? They were solving the problem of, I guess, connectivity in some ways. But now those things are the problem, or connectivity is the problem. I have how many email accounts? I have 3 cell phones. I have, IB and Facebook, and I want to be less connected. So for me, the problem that AI could solve is helping me deal with all of this connectivity that I have.
Absolutely, I agree, right? So what you're basically saying is that I'm overwhelmed with information, and I would like something to, scan out from this information and figure out what is really important and bring that to me in a better way.
Just the signal, no more noise, please.
Yes, definitely yes. And is that something that the current engine can do? Probably with enough training, definitely yes. Is that the use case that we will end up with? Maybe yes.
So would you say, and I'm thinking about our audience, an investing audience, who have just watched this AI euphoria, and we've seen something like an NVIDIA, but some other names just go kind of off the charts. Would you say it's too early to make that investment play?
No, I think that if you don't play in this game, then definitely you're going to lose. Right?
So it's not too early to go into some of these names?
It's not too early. And to a certain extent, what I would like to also mention is, we look at it and we say, okay, wait a minute, the ChatGPT just appeared in our life about 6 months ago, right? So you look at it and you say, in 6 months, it's done so much, right? Wait a minute. OpenAI is 7 years old.
Right.
It takes a lot of time to create value. And the first part of this value the value generation journey was about creating the technology, and now we're looking for the use case that will make it valuable. In some cases, it's already there, but in some cases, it's not there yet.
All right, do you have an overarching investment strategy? I mean, you've created and sold $2 billion businesses. Probably people come to you with pitches left and right all the time. Is there one kind of overarching strategy that you use to drive your investments?
I do, right? Because at the end of the day, my mission in life is to create value. And I can create value through different ways. One of them is, building solutions to a problem that will help you to become better. And so this is Waze or Moveit or Pontera or Zoomcar or C3 or Fairfly or many of my startups. And the other one is through guiding and mentoring and teaching others, right? And the book is about fulfilling my destiny of creating value as sharing the know-how. And to a certain extent, when you share the know-how, when I go into a company and I help them, at the end of the day, what happens is that they sign up to my know-how, and that increases their likelihood of being successful. So my methodology is not about guessing what's right, it's creating what's right.
So for entrepreneurs who might grab your book and kind of get, fall into your philosophy and benefit from it, I do wonder, Ori, what you think is one of our biggest problems today that needs solving.
We can look at many problems, right? So a lot of us are speaking about, wait a minute, we are way too much connected, right? You look at the younger generation and they are connected into social media in levels that are beyond imagination, right? And in some cases, they're not happy, right? And so happiness of younger generation is a challenge, right? You look at medical services, right? Medical services in the U.S. are 5 times more expensive than they are in Germany. Now, it's not
Matt
that
used to live in Germany. He talks about it all the time. Yeah.
And it's not that they're better in Germany, in here than in Germany, right? It's simply 5 times more expensive. So you look at it and you say, okay, wait a minute, this is waste of resources, right? We started Waze in 2007 in order to help people to avoid traffic jams. There are more traffic jams today than there were in 2007, right? So obviously, this problem is not done yet, and we will need to address that as well. And so there are a lot of big problems that needs to be addressed, and I think that at the end of the day, it's the entrepreneurs that are going to change the world, and our role is to encourage them.
Well, love it, and love when you come in.
Very cool.
So great. Ori, thank you so much. Ori Levine, co-founder of Waze, of course. Check out the book, Fall in Love with the Problem, Not the Solution.
news, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 4:21 on Wall Street. We do check markets all day long here at Bloomberg. Turned out to be a mixed Thursday. The Dow lower, the S&P, NASDAQ both higher after struggling for direction throughout most of the session. S&P 500 index did manage to halt a three-day slide. S&P today up 16, a gain of 0.4%. Dow Industrials lower by 4, little change there. NASDAQ up 128, a gain of 1%. The tech-heavy NASDAQ 100 index rose over 1% amid a rally in giants like Amazon, Apple, and Microsoft. 10-year yield 3.79% with the 2-year 4.78%. Spot gold down $18 the ounce. The 1914 drop there of 1%. West Texas Intermediate crude back below $70 a barrel, down 4.3% today, down $3.08 a barrel to $69.45. Bitcoin 30,146. Bitcoin up today by 0.5%. Again, recapping, stocks ended the day mixed with the S&P up 16, up 0.4%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Carol Massar along with Matt Miller live here in our Bloomberg Interactive Brokers studio on YouTube and Bloomberg Originals. Well, our Bloomberg News team of Hema Parmar, Lindley Lin, and Sarah McBride reporting today that secondary markets, where backers of closely held startups can sell their stakes to other investors, are drawing increasing interest from venture capital funds and other money managers that are really looking to snap up chunks of private companies on the cheap. It's a sign of the times, Matt.
Yeah, well, I mean, I've seen this sign of the times before, so it's a sign of the times again.
So warning.
Yeah. Well, no, I mean, for example, before Facebook IPO'd, secondary markets were all the rage at the time, and if you'd gotten the stock then, you'd have had a lull, but you would be very wealthy right now.
No, it's a really good point. So let's get into it. Bloomberg News hedge fund reporter Hema Parmar is here, and Javier Avalos is co-founder and CEO of Caplight joining us, and they are a provider of pre-IPO class market data, and he is with us on Zoom from San Francisco. Hema, though, set up your story. Give us the background.
Right. So there's a few things that are going on right now in the market. We're seeing founders, employees, investors of startup companies really under pressure right now. A lot of them seeking liquidity, and so they're looking to get cash, maybe because the job market is difficult, maybe because interest rates are rising, there's fewer exits for employees now if there's not as many IPOs, and so they need cash, and so they're looking to increasingly in this environment sell their shares on the secondary market, or firms, hedge funds or venture firms may be looking for liquidity as well for the similar reasons, also looking for liquidity, selling those shares on the secondary. The other side of that is that there's great opportunity to buy stuff because the prices are incredibly attractive in this environment as valuations have fallen.
So Javier, is your company then kind of like a Bloomberg for private companies?
I think that's the exact right way to characterize it, Matt. So first of all, thank you for having me on, Carol and Matt and Hema, for including us in the article. What we do is we really work to aggregate a lot of the market activity that's happening in the secondary market and bring transparency to the market by centralizing this pricing activity into one place. So when Hema or others want to shine a light through the form of media, Caplight can be a resource in terms of saying what the pricing of these private companies is based on what we see in secondary trading.
So do secondary markets then use your data in order to make the transactions more transparent?
That's exactly right. So the biggest users of the Caplight platform are actually brokers who have a responsibility to their clients. As Hema described, in some cases that's employees or founders, in other cases that's institutional investors who are looking to sell their stock pre-IPO for whatever reason. We would serve the broker who is then building that client relationship and effectively helping them to buy or sell something.
So what your data is actually, what Hema said is that valuations have gone down a lot, correct? And this is why, whether it's a hedge fund or other private investors, they're saying, wait, here's an opportunity for me because these are really distressed, it seems like, assets.
That's exactly right, Carol. So and to quantify that a bit, on average, we see pre-IPO unicorn-type companies trading at about a 50% discount from where the VC that invested in them last valued them. And that discount has been increasing for the past 12 months and is finally starting to stabilize. So there's an old adage in the private markets that private markets tend to lag what's going on in the public markets, and that has played out almost exactly in this latest cycle, where private company data is about a quarter, maybe a little bit more, lagging behind publics. And so when we saw the public market turn in October and start to rally, private markets are following that trend very closely, just in a quarter or two delay.
So as we see the buying that's increasingly, prominent in the space, how do we tell whether someone is buying because they believe in the company and they think that they can get it at a very attractive price, or if we're seeing some buying of companies where the firm is so invested in over so long that they just really can't afford to have that company struggle, therefore will want to buy more shares or provide them with liquidity or something?
Yeah, you are right to point out it's absolutely a function of both. So we have seen quite a bit of existing investors snapping up shares, especially back in Q3 and Q4, so mostly Q4 and leading into Q1 of this year, where investors who are already on these companies' cap tables, who have full information into how these companies are performing, saw the 50% drop that had been happening over the past couple of quarters, and saw that as a perfect entry point to kind of start building on exposure that they already owned. But our market is pretty thematic. And so when I think about answering this question of what are investors looking for, how are they picking the right ones, oftentimes they're playing certain themes. This is not dissimilar than the public markets. A massive theme that is being played on right now is regenerative AI, right? And so a lot of what's pushing the public markets up is also pushing private markets up. So you have companies like OpenAI or Anthropic or Databricks or Solonis who are sort of benefiting from these tailwinds that are pushing the markets up more broadly.
We've seen a couple of times, Javier, where private markets have gotten, secondary markets have gotten really big, as I mentioned before the Facebook IPO, when there were so many unicorns out there. We saw that as well, employees just looking to cash in, buy a big house or whatever before they went public. What do you think's driving it right now? Is it just the valuation drop and the fact that there's a lack of exits?
So I think that lack of exits piece is a point that probably deserves more attention. This might sound like crazy to say, than it's already received. And a sort of a loser in that situation that is not often talked about is the employee, or even some of the very earliest investors like angel investors. These are folks who expected an exit event to happen in late 2021 or early 2022, and for really market-driven and macro reasons, their private company, shelved that offering and have sort of like basically put it on hold indefinitely. And so what's been driving a lot of liquidity seekers to the market is you have in your head that you're about to receive a very large payout for work that has been happening for years, and suddenly that's delayed indefinitely. Now you're turning to the private markets to help get you some of that cash that you had already sort of mentally been budgeting for. So that's kind of where the sell side comes from. The reason the buy side is coming back very strongly is that IPO window is starting to crack open. So every time you have an article talking about Klaviyo filing or Rubrik hiring bankers, Turo refreshing a registration statement for a public offering, these are bits of news that get pre-IPO investors really rushing back into the space to help clean out some of the supply that's being added to the market by employees, founders, and early investors.
Javier, in terms of what you're seeing and these depressed valuations, but obviously investors finding some opportunities, does it give you any kind of clues about the broader market environment, as we are kind of in this funny place where I feel like every day we're debating what a Fed speaker says or Jay Powell says or what's going on with the economic environment? So I'm just curious if it gives you any clues about kind of the health of this overall financial market.
It does. I mean, I really think about the pre-IPO and private markets generally as a proxy for risk appetite. And so, when we start to see the bid to ask volume ratio at Caplite starting to flip towards more of equilibrium between the amount of buy interest that's in the market and the amount of sell interest, and that's the closest, now is the closest time we've been to that equilibrium really since 2021. That starts to give me confidence in the broader rally that's happening across capital markets. I think we've worked with private company CEOs, CFOs to help them kind of understand when they should even be thinking about raising additional primary capital, and or if they should be thinking about a public exit for the first time in 12 or so months. And so in a way, the adage that I referenced earlier that said private markets lags public markets, while that is true from a pricing standpoint, the risk-taking sentiment that happens in our market can sometimes be predictive of when companies are going to come out and raise primary rounds or even potentially list on the public markets.
On that point about the bid-ask spread, we're seeing not as many deals actually done compared to the opportunity. I'm curious what you think it'll take for the transactions to actually increase.
And just got about 30 seconds, Javier.
Of course, yeah. So keeping it brief, the biggest necessity was a reduction in valuations, and now that has happened, we're seeing more bids come into the market, larger bids come into the market, and whenever we see these three factors, reducing prices, more bids, and larger bids, we tend to see closed transactions. So I actually, and we ourselves are seeing a lot of these through our platform. So I actually think this next quarter, Q3 of 2023, is going to be a pretty active quarter in terms of reporting out closed secondary transactions.
Really cool perspective. Very cool.
Yeah, agreed. Very awesome.
Javier, thank you so much. Javier Avalos, co-founder and CEO of Caplight, joining us on Zoom from San Francisco, courtesy of our own Hema Parmar. Thank you so much for the story and bringing us Javier. She, of course, is hedge fund reporter at Bloomberg News here in our interactive brokers studio. Should we do some news?
Let's get over to Nancy Lyon. She's in the 99.1 newsroom in Washington, D.C. Nancy?
Thanks, Matt. Coast Guard officials say they've found debris from the Titan submersible on the ocean floor 4 days after it went missing on an expedition to the Titanic. Mission expert Paul Hankin describes what a remote-operated vehicle, or ROV, discovered this morning.
The initial thing we found was a nose cone, which was outside of the pressure hull. We then found a large debris field. Within that large debris field, we found the front end bell of the pressure hull. That was a first indication that there was a catastrophic event.
Hankin says it appears there was a massive implosion of the vessel. They'll continue to map out the debris field to determine what exactly happened. It's been 4 months since a Norfolk Southern train derailed near East Palestine, Ohio, releasing toxic chemicals. Today marks the first of 2 days of hearings in the community, organized by federal transportation safety investigators. Today, firefighters who responded to the fiery derailment said they struggled to communicate with one another and were unable to quickly identify the hazardous chemicals the train was hauling. Indian Prime Minister Narendra Modi continues to make the rounds in Washington, meeting earlier with President Biden to tackle a variety of issues and then addressing a joint meeting of Congress.
It is always a great honor to address the United States Congress. It is an exceptional privilege to do so twice.
Modi tonight will be the guest of honor at a White House state dinner. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Nancy Lyons.
updates, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 4:40 on Wall Street. We do check markets all day long. At Bloomberg, turned out to be a mixed Thursday. The Dow lower, little change, but still down almost 5 points. The S&P 500 index up 16, up 0.4%. NASDAQ up 128 points, up by just about 1%. The NASDAQ 100 index advanced today by 174 points, up 1.2%. 10-year yield 3.79% with the 2-year, 4.78%. Bond yields climbed after major central banks warned about the potential for more rate hikes, with officials signaling they are nowhere near ready to declare victory over inflation. Spot gold down $19 the ounce, down 1% to $19.13. West Texas Intermediate crude back below $70 a barrel, down 4.2%, $69.46 on WTI. Well, as for markets, Veronica Clark, Citigroup economist, told us right here on Bloomberg Business Week that the backdrop is confusing.
We're all waiting for this recession that still is not happening. And of course, with that recession not happening, we're not getting the slowdown in spending or activity, and that means inflation is still high. That means the Fed is still raising rates. It is a very confusing backdrop.
And you can hear more of that conversation on the Bloomberg Business Week podcast. You can download it wherever you get your podcasts. Today, we saw Tesla shares advance by 2%. Morgan Stanley has downgraded Tesla to equal weight from overweight, saying high expectations on how much the company will benefit from artificial intelligence has, quote, brought the stock to fair valuation. Again, Tesla today up 2%. So far this year, the stock is up 114%. Recapping, stocks end of the day mixed. The Dow lower by almost 5 points. S&P up 16, up 0.4%. NASDAQ up by 1%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
Right, Charlie, thank you so much. Charlie Pellet with a Bloomberg Business News Flash right here on Bloomberg Business Week on Bloomberg Radio. Carol Master along with Matt Miller. Matt in, of course, for Tim, as we continue to explore a world where equality and diversity and inclusion are lacking. Today we're going to look at it, Matt, from the perspective of small business and diversity. And you and I talk about it a million times. I mean, if we had a buck for every time we cite the McKinsey study and diversity and the importance and how it impacts the financial bottom line. This should have been solved years ago.
Yeah, no, absolutely. But, one of the problems is the structural impediments to wealth creation for Black and other minorities in this country have really held them back. From,
not equal
for
access.
example, home ownership, or small business ownership, and that's what we're going to focus on right now.
All right, Sheena Ashley is with us, president of the Insight Center over at Capital One. She's with us on Zoom in D.C. Sheena, nice to have you here. Tell us a little bit about the program and the study that you guys recently did.
Yes, great to be here, Matt and Carol. Thank you so much for having us. We took a study, a deep dive into sort of looking at this question. There are a lot of efforts right now that are focused on small business ownership as a pathway to addressing the racial wealth gap. But it's a very much understudied topic in that we haven't had a lot of research out there in the field that really looks at the returns to wealth for the business owner himself or herself from owning that business. And over history, we have seen for the average business owner that business owners generally have greater wealth than non-business owners. But that's looking at the average American, and that's typically looking at the white business owner. So we wanted to disaggregate the data, look very specifically at Black and Hispanic business owners. And while others have looked at this question nationally, we wanted to take a place-based lens on this. And we went into a mid-sized city in Richmond to see that at that level, do we still see patterns of which business owners yield a wealth return from their business ownership. And what we found was a bit surprising that business owners actually had half the wealth of non-business owners through the time period from the study. So looking between 2017 and 2022, non-business owners had greater wealth gains than business owners in that enrichment. We think, though, that some of that could be
the pandemic.
Yeah, definitely.
Yeah.
Definitely. This was a time where there was just a lot of government support to non-business owners and also to business owners too. But business owners were trying to pour a lot more of that capital back into their business so that they could just survive. And so the business owners may not have been looking to capture some of that for their own wealth building.
What is the difference between Black owners and white business owners in terms of the wealth effects?
Yeah, so even in this study where we did see some Black and Hispanic business owners really thrive and build the kind of wealth that we want to see, 35% of business owners in the study gained at least $188,000 of return from their business. And that number is significant because it's the difference in the racial wealth gap on average between Black and white people in this country. But even those that had that high level of wealth gain, it was still only 25% of the wealth gain that a white business owner in Richmond had. So the racial wealth gap still persists.
Why is that? Why is that? Why is that?
What we found, though, that for those that were able to actually make wealth gains, it was under the right conditions. So there's access to capital, which is number one, a condition that helps business owners thrive. But more importantly, what we found in this study was that social capital and knowledge capital were essential. And so access to the kind of networks and incubators and sponsors and mentors that really help business owners understand when is the right time for growth, how to price their products, how to tap into new markets. We found that those business owners, regardless of race, that had that kind of access to networks and knowledge were those who were able to succeed.
So what do we do about it then? We hear these kind of statistics all the time, and they're disturbing, to say the least. Depressing probably is a better way to put it.
But the persistence of it, right? That we continue to talk about it, and it doesn't change significantly.
But what can be done to create, social knowledge networks, if you will, for Black and Hispanic, potential business owners, so that they can reap bigger benefits?
That is a great question. Yes, this is not a study to highlight the problems once again, but one to seek solutions. And one of the things that we were interested in, because this is a time of massive public investment in small business, the historical levels of funding coming out of Treasury and out of the private sector to support small business owners in their growth, much of that is going directly to small business owners themselves through the form of grant and different kind of capital. But what this study raises as a different solution that we also need to think about, in addition to the capital that's going directly to the business owner, is support to create an ecosystem that will provide that kind of network effect and the access to knowledge and insight and expertise that the business owners need, not just to start a business, but to continue to grow and expand that business over time. And so what we're calling for is just greater investment in technical assistance and more use of technology to be able to bring that technical assistance to the business owner in real time. We saw that Black and Hispanic business owners, even though they're in communities like Richmond, which are so rich in these resources, there are accelerators and incubators and CDFIs, all who exist within the community. But Black and Hispanic business owners aren't tapping them at the same rate as white business owners. And part of that is because it's not offered online in a virtual environment where you could work on it at different hours of the day or tailored from a cultural competency perspective.
company news headlines on Bloomberg Radio.
From Bloomberg World Headquarters, I'm Charlie Pellet. We begin with a developing story and a headline from the Bloomberg Professional Service. Adani Group statements to investors are drawing U.S. regulatory scrutiny. Again, just the headline. We'll have more details as they become available. J.P. Morgan Chase is going to pay a $4 million fine to settle SEC allegations that the bank mistakenly deleted millions of electronic records, leaving communications unavailable to regulators in a dozen investigations. J.P. Morgan Chase shares today down by 1.9%. NVIDIA's stratospheric ascent has lured at least 100 more ESG funds in recent weeks. And with that story, here's Bloomberg's Tom Busby.
Charlie, it has transformed the company into one of the most popular stocks among asset managers who integrate environmental, social, and governance metrics into their investment strategies. Now, according to Bloomberg data, there are now over 1,400 ESG funds directly holding NVIDIA. The data show a further 500 are indirectly exposed. NVIDIA shares hit a record this week, bringing gains so far in 2023 to about 200%. According to the data, the company is now more popular among ESG investors than traditional green powerhouses such as Vestas Wind Systems and Tesla. Charlie?
And that's Tom Busby. Today we had shares moving lower of NVIDIA down by less than 0.1%. And those are some of the company stories that we're following for you at this hour. I'm Charlie Pellet, and this is Bloomberg.
You're listening to Bloomberg Business Week with Carol Messer and Tim Stenevec on Bloomberg Radio.
Matt Miller in the Interactive Brokers studio. I'm filling in for Tim for the summer. Carol Masser, she's here all the time. We got a lot coming up. Joel Weber's going to come in the studio a little bit later. We're going to talk with him and Nick Quirolo.
We have a really cool guest
about essentially about the Supreme Court, more about the Supreme Court and what it's going to decide on affirmative action. And then we're going to talk with Ken Kencel. I'm really psyched about this because you kind of bigged him up to me. You've done it at Milken a few times, and so I went back and I listened to one time. So I went back and I listened to Barry Ritholtz's Masters in Business podcast with him, and it was very cool. And we're talking like barbarians at the gate, you know, in modern times.
All right, first up though, let's get a check on world and national news. Nancy Lyons in
Schiff for comments he made about former President Trump's alleged ties with Russia. Well, today the focus in the House was on impeaching President Biden for his failure to defend the southern border.
Republican Chip Roy presented the resolution.
People I represent are sick and tired of a federal government abdicating its fundamental duty to defend the border of the United States through dereliction of duty and a refusal to actually follow the laws of the United States.
Ranking Democrat Jim McGovern.
Nothing about this is serious. Today, they're dishonoring this House by bringing to the floor a ridiculous impeachment referral resolution against Joe Biden because Donald Trump told them to.
The impeachment next step would be taken by the Homeland Security Committee. In Washington, Irv Chapman, Bloomberg Radio.
Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Nancy Lyons. Now back to you, Carol and Matt.
All right, Nance, thank you so much. Carol Masser along with Matt Miller here in our Interactive Brokers studio. We got a really cool hour coming up, so don't go anywhere. In the meantime, do you want to talk Stevie Cohen, Ken Griffin, and Stevie Cohen?
The movie coming up with Seth Rogen and...
See, I thought you were going to go somewhere else.
You know, Vincent...
Just when I think
what's
I
his name?
Figured out.
D'Onofrio. D'Onofrio. So I love this guy. Originally from Full Metal Jacket.
Yes.
Remember he plays...
he also had a show. Wasn't he one of the Law and Order dudes?
He plays Pyle in Full Metal. Yeah, he's on Law and Order. I've never really seen that.
But he got kicked out, or I don't know, or something.
But
happened.
yes, but he's going to play Stevie Cohen.
He looks like it. That's pretty cool.
That's good for Cohen, I say.
Who else? Who else is in it?
Seth Rogen is in it.
Yeah. I'm trying to think. He's going to play Plotkin.
Gabe Plotkin.
Yeah.
Right?
Yeah.
Who now is, I guess, the new majority
Nick
owner
Offerman plays Griffin from Parks and Recreation.
Yeah.
I love that guy.
Is that Ron Swanson?
What?
Is that Ron Swanson? It's Ron Swanson, right? Someone else help me. Does somebody
Nick
watch
Offerman.
Parks and Recreation?
Oh, yeah. Oh, you mean the character.
Yeah.